the publisher of Business Day, and I'd like to take the delight on behalf of Business Day to welcome you very warmly to this Business Day Pensions Conference with the team, the future landscape, and economic levers. This has been a year defined largely by the health pandemic and the economic crisis that it has occasioned. Companies have had to respond in new ways to remain competitive, to remain afloat. And I think that this event is coming at a very good time, given that on the back of the hopes of the success of 3 or so vaccines for the coronavirus, people are now beginning to look forward with hope to 2021. I believe it's time for all of us, managers, especially our colleagues drawn from the pension fund industry, the private equity sector, and others interested in finance and financial management this morning. A good time for us to begin to reimagine that future that lies ahead of us and begin to prepare to take it with courage and a clear vision. Without any question, one of the greatest things that has happened to Nigeria is easily the contributory pension scheme that was launched in the time of General Olusegun Obasanjo as President and Head of State of Nigeria. There are still some significant hurdles to be overcome. We are indeed creating significant assets by way of contributory pension. I believe that the challenge of finding vehicles for expression for that huge pool of asset that has been so accumulated remains something that we all are eager to resolve. Pension has two sides. First part is bringing together the contribution, which we do monthly. But there is a second side, and also a very important side, which is ensuring that we turn over that contribution so that there will be value for those who make that contribution when it is time for their retirement. Clearly, there hasn't been a significant drop-off in pension contribution monthly given the COVID. So we congratulate the industry for being so resilient. My bit this morning is a rather simple task to welcome you warmly. So I welcome you all warmly, and I welcome our speakers especially. I thank those who have been very supportive of this event this morning, including, of course, Crusader Sterling Pension Managers, as well as Infra Credit, our main supporters for today's conference. We have a very impressive lineup of speakers this morning. We will very shortly yield to those speakers. But let me, at this point, say that our first speaker will be Dr. Andrew Nevin, who is joining us this morning from Canada. Clearly, you must have slept early to be awake at this time, or perhaps you didn't sleep at all. So we would like to acknowledge the sacrifice that you have made to be with us this early this morning. Dr. Nevin is Chief Economist and indeed a regular face for PricewaterhouseCoopers in Nigeria. I am happy to say that Andrew is a friend of mine, and with so much delight and respect, let me now, without any much ado, invite Dr. Nevin to address the gathering. Thank you very much, and do have an engaging dialogue this morning. Thank you.
Thank you so much, Frank. That's such a kind introduction. I have to confess, though, that I've actually decamped. Where I was in Canada getting up early, but I've decamped to the UK, so it's not so bad. But I thought this morning I would cheer us all up with a Canadian picture of the river near Ottawa and some of the leaves turning on that. I was actually looking for the picture from my office of the Atlantic Ocean, which is also lovely. But in these dark times, these things cheer me up. But thank you so much for that, Frank, and thank you to everyone who's here today. I just wanted to play a special tribute to Business Day and all the wonderful journalists that I come in contact with. I mean, people may know we sponsor the Business Journalism Awards. Business Day always gets its share of the wins in that. But in these times in the world and in Nigeria and some of the challenges that we face, I think journalists play a particularly critical role both in business and in politics and transparency and openness in the society. So it's not an easy job, and I really want to pay tribute to all the journalists and all the people at places like Business Day and the other print and internet and television and radio. And they're all making a difference to Nigeria. So thank you so much. Yeah, so my role today is to, sorry if I looked down, I'm just looking at my notes. I don't want to leave anything out here. I just spent a few minutes, I may use some slides talking a bit about the pension, excuse me, the pension structure and the pension industry and how it fits into kind of the economic future of Nigeria. Let me start by saying something that I think everyone who's here with us this morning would agree with, I hope, and I think Frank said very well, which is that the current structure of the contributory pension system in Nigeria is really something to be proud of. I mean, it was set up with very strict regulation. The regulations have been followed. People's money are safe. The relationship between the PFAs, the regulator, the custodians, I think, is very solid. The cautious nature of what assets need to be invested in is also, I think, very well understood. And it's great. I forget the exact number right now. I think it must be 8 or 9 trillion assets under management. And of course, people are going to now have a chance, if I understand correctly, to move their pension funds so there'll be more competition between the PFAs. But I mean, there's a number of financial innovations in Nigeria that are really kind of world class. BVN, obviously, but I would also put the PFA structure right up there. Maybe just share a few slides if I can get permission. I'll try to see if this let's see works. Just a few slides. I'll put it on, just to hold it, bear with me a moment here. A few slides. I'll go through some of them quickly on that. Let me just do, I can remember how to do full screen. Oh no, I can't quite remember how to do full screen. But anyway, I think people will get the picture here. Let me just start by talking a couple of minutes. I'm only going to take another 15 minutes or so. But go through this quickly, just to remind us kind of the scale of Africa. I mean, there is something that's happening. I think 2020 is a pivot year for us in Africa, but also globally, to understand just the scale of Africa and the impact it's going to have on the global economy. And I say this as someone who went to China the first time in 1983. There was not a single private car. People didn't really grasp. No one was talking about the impact that China would have on the global economy. And of course, 25 years later, it was the largest producer, the largest consumer of cars, for example, when there was zero in 1983. I believe the economic transformation of Africa is going to have a similar impact in Africa and in the world. And just from a sheer demographic viewpoint, this, as I said, is a real pivot point. This looks at the number of births per year across Africa versus the rest of the world. So the big bar is the rest of the world. You can see right now we have about 40 million births a year in Africa. We have less than 100 million in all of the rest of the world combined. And that's already extraordinary demographic weight, but it's just closing as we go through. And even at an individual country level, you can see India and China, we always think of as enormous population giants. But in fact, in terms of number of births over, again, these 5-year periods, you can see Nigeria is going up and India and China are actually going down. And you can see how much demographic weight we have. One country in Africa, Nigeria versus Russia versus Germany versus the UK, Brazil, Indonesia, you think of as large countries. And this is going to have an incredible impact on the way pensions and investment has to happen in Nigeria. Let me just skip a couple because we want to get to that. So, but standing back from all of this too, what does it mean for overall population? I mean, we're projected to be third most populous nation by 2100 is the official UN projection, but there's actually a new projection that comes out. If you look closely at this graph, the pink bar is the new projection. And this is really extraordinary. I don't know if this will come to pass, and I obviously won't be here that long to see it, but right now there is a projection that Nigeria would be the second most populous nation in the world this century. Now, you might say this century is a long time, but the truth is any baby born in Nigeria today has high probability of being alive in 2100. It's not so far in the future. And this is something that's totally new to thinking that, because China's population is shrinking very rapidly. Working age population already shrinking, and because of the one child policy, its overall share, number of people is going to start to shrink soon. So this is kind of all a way of saying that from a demographic viewpoint, which affects all these investment and pension flows, the weight of Africa is really this year to me is a pivot year on that. And I think people will see that both internally and externally, and it's going to shape everything for decades going forward. So now let's relate this to the Nigerian economy a little bit, and I think all of these are some of the themes that we talk about, and each of them I think relates to the pension industry in an important way on that. And I won't necessarily go through all of them, but I'm going to a couple of them I think that are critical. You might have seen this morning, I mean, we've said for some time how the whole economy is shaped by the diaspora remittances. This morning, you might have seen the CBN announce, in fact, that it was going to allow people to transfer money into a U.S. dollar account and keep it in U.S. dollars, and then they can exchange it the way they want, effectively in the parallel market. I mean, of course, this is being forced upon the CBN essentially because no one is going to be sending in remittances at 380 when they can get Aboki sorts of things as I do. It's the other way at 500 on that. And this change by the CBN is I think a really critical thing in kind of moving to a single exchange rate. But the reason it's important for the pension industry is not only the pensioners need to find investable assets, as Frank said, but also the diaspora actually has the same problem. They want to find investable assets. And I think that there is going to be a convergence of this flow and the pension flow and putting pressure to create safe assets that people can invest in. Similarly, real estate, we have said for years and put out our paper, I think last year, that the most important sector in the economy is actually real estate, particularly residential real estate. The economy cannot do well unless this sector does well, and it's really struggled the last 4 or 5 years. We put some numbers on what's called dead capital. So these are assets that are not really producing return. They can't be transferred. If you have a piece of property in Lagos, you could easily transfer it. You then sell it, get the cash, move in with your sister, start a business. So it really impedes the velocity of investment flow on this. But for the pension industry, this is absolutely critical, because if you actually look at the way the pension structures work in whether it's Canada, the United States, Australia, South Africa, UK as examples, a huge amount of the investment in pension funds, of course, is in long-dated assets and in mortgages related to real estate. So we need to create the investable real estate to be able to create the outlet for the pension funds. And then at a very basic level, I mean, if you ask PwC what is wrong with the Nigerian economy, I mean, we need to grow at 6 to 8% per year at least in an inclusive way to make any dent in unemployment and poverty. And of course, we've been under that. I was very pained to see the CBN governor come out this week and say that the growth rate in 2021, the headline GDP, is going to be about 2%. Which means we're going to have another year where it's below population growth. Very, very painful. And of course, the governor did come out and say last year, 2019, at the beginning that he was targeting double-digit growth, and we remain a long way away from that. Now, why is that? Well, this chart in one chart sort of shows this at a very basic level, which is that people are not investing enough in Nigeria. So the yellow line is India, and you get, in economist terms, gross fixed capital formation of roughly between 26 and 29%. The power is kind of 6 to 8% growth. I mean, it's a mathematical impossibility to grow without investment, grow GDP without investment. And we're below that. We're 16, 17, 18%. So, a little more than half of what's required. As long as we're at this investment level, then we will be below population growth and headline GDP, which means we'll get poorer and poorer per capita. And of course, for some time, PwC has posed the question, how many years can we get poorer and poorer per capita without having some sort of social crisis? And events in recent months show us that maybe we know the answer to that, sadly. But I mean, from the viewpoint of the pension industry, again, the pension industry has this huge pent-up supply of investment. It just requires the creation of these investable assets. And one thing, just to sort of highlight a little bit on this, that term, I don't use this a lot, but I think it is relevant for the present time. There's a term in finance called financial repression, which is when the structure of the sort of regulation and the way a monetary policy is conducted basically forces people to lose money. And we have reached that point in Nigeria. So because of the structure of the borrowing, the relationship with the OMO market, and the fact that the pensions are so big but don't have this outlet for investable assets, they're forced to invest in government paper, which currently, if I remember right, is paying 1, 2, 5%. So you have a situation where people are contributing to their pension, the companies are contributing to their pension, they're doing all the right things, but they are mathematically guaranteed, I think 70%, experts can correct me, at least 70% of the assets are in government paper. So you have a situation where people are earning a negative real return because inflation, headline 14, 15%. So if you're earning 3% or 5% and inflation is 15%, you're getting poor at 10% per year. And this is a real challenge. And I think the industry needs to both, create these investable assets, but also kind of come out and be a little more honest. I don't mean the industry is dishonest, but needs to be some clarity in the communication. It is not sustainable to have people losing 10% of their pension every year to inflation without some reaction. To take an analogy, we've just seen what's happened because we're losing so much money on the transfers of US dollars, pounds, whatever, into Nigeria. The central bank was forced to change that rule so people could keep more of their money. I think similarly in the pension industry, this financial repression is reaching a really dangerous point, and the industry needs to kind of address this. I mean, what do you want? You need to have government bonds earning some positive return for the investor, which means that either inflation, we need a combination of inflation coming down, and we can have a long discussion about that. And we need a combination of interest rates actually coming up from their current levels on that. But what we have right now, of course, is not going to encourage investment. But from the viewpoint of policy, unless people invest in Nigeria, and this includes Nigerians, it includes the diaspora, where there's a lot more work on how to structure vehicles, it includes outsiders. But those first two groups need to come first. Unless there's roughly double the rate of investment into Nigeria, then we're going to continue to be have this challenging headline GDP situation at the end of the day. And I don't know how many more years I have left at my advanced age, but I want to live long enough to see a prosperous Nigeria. Related to this, just quickly, I've got about 5 minutes left on that. Is just the informal economy. I mean, I think one of the great steps forward for this, of course, is to bring people more into the formal system. And now I know there's a lot of work on creating pension structures for the informal sector. I think that's critical work, both to bring the informal people so they start to have some savings and contribute to capital formation, but also to eventually bring them into the formal system. And of course, there needs to be discussion about why people don't want to join the formal system. And then Finally, I'll just one thing I think that's very critical for all of this asset creation is that assets need to be created all around the country. So we started kind of thinking about this 5-6 years ago. We've talked about the need for growth across Nigeria. And I think sometimes when we're in Lagos or Abuja, kind of in that Lagos Abuja bubble, and we don't always recognize, first off, we don't recognize there's actually a lot going on across the country. And really want to pay tribute to many of the states, and particularly the governors who are making efforts there. And it's maybe one I'll cite. I was doing a session the other day, and I had never met His Excellency Governor Muhammad Bauchi, but he was absolutely fabulous. This was a discussion about privatization at the state level. And Frank, it might have been your conference. I'm sorry, it wasn't a business day conference, but it was really very impressive. The governor, His Excellency the Governor's understanding of the issues of what Bauchi needed, what assets Bauchi had, how to unlock those dead assets, what investors wanted. And I think that if we're going to create the kind of investable assets that that we need to have to kind of drive to become more prosperous, this needs to happen across many states. And of course, I look at some states that are doing well. I'll cite, for example, I know it's been a little political, but His Excellency Governor Obaseki done very well. Governor, obviously Edo State, Governor of Ekiti State, His Excellency Fayemi is fabulous. The governor, His Excellency Governor of Kaduna State, just to cite 3 examples of governors that are very focused on kind of inclusive and sustainable growth. But for the pension industry too, we need to make sure that you're looking at assets that are not necessarily just Lego based or just Abuja based assets in real estate and infrastructure, but also in commercial businesses on that. So, and then I also want to say there's obviously, I think, a close relationship between all of these investment vehicles that are going on, investment structures. And what I mean by that is that the stock exchange, FMDQ, the SEC, the pension industry, InfraCredit, NSIA, the private equity structure, the venture capital structure, some of the DFIs, so the ones like BOI, like the domestic ones, BOI, Development Bank of Nigeria, but also some of the international ones like CDC or Porco from France, need to kind of look together at the entire ecosystem. And the SEC, for example, is about to embark on a new exercise to create a master plan for the capital markets. Obviously, PENCOM and the pension industry and the PFAs need to be there, but everyone is on the same side of creating kind of a much more robust capital market structure, so that we both create these investable assets, we give people something safe and that gives them a return to investment, pension, and other monies in, and we also create the pools of capital and invest them wisely in all of these assets, particularly long-term assets that are the basis of life insurance and pensions. So let me stop there. My time is up, but just wanted to give a little flavor of some of the issues I think that are foundational for this. But again, let me just repeat first, thank you to Frank and Business Day for putting this on, and to all business journalists who are doing a great job. And thank you to the pension industry. But this issue, I think, of financial oppression, I want to leave with you to really reflect and think about, because as I said, we've just seen an unsustainable system with remittances change overnight, literally. I mean, this was only announced yesterday. As the CBN reckoned, that gap is too wide. That's between 400 and 500 gap was not sustainable. I think we're in a similar situation in the fixed income market, and particularly the pension market, where the gap, people cannot have continued real losses on their investment portfolio, pension portfolio, without some fundamental change. And I think the pension industry needs to kind of be at the forefront of that. So let me stop there. Again, thank you to Frank and to everyone who's here today, and to the entire industry. And God bless Nigeria.
Andrew, thank you so very much. Andrew is a well sought after speaker around the world, and you can see how by his professorial approach in such a very short time, he has put so much into his presentation. We appreciate your time, Andrew, and we do look forward to you joining us physically in Nigeria. Without any question, a lot of food for thought from across the broad spectrum of economics and social evolution in Nigeria. Andrew has indeed helped to set the tone for today's conversation. Once again, thank you so much, Andrew, and let me now pass on the baton to my colleague, Seun.
Thank you so much, sir. Okay, to take us further in today's dialogue, we will be calling on the president of the Pension Fund Operators Administration of Nigeria. That's in the person of Mr. Wale Odutola. He will be delivering a goodwill message to our teaming audience. And a brief introduction about Mr. Wale Odutola. He is also the current managing director of ARM Pensions Manager. Mr. Odutola is a seasoned portfolio manager with extensive experience in research and managing global portfolio equities and fixed income assets. So I would like to invite Mr. Wale Odutola for his goodwill message. Over to you, Mr. Odutola.
All right, thank you very much, Seun, and a big thanks to Business Day for organizing this event. I think clearly from the conversation we had and the presentation by Andrew, there's a lot that our industry, the pension industry, needs to do in order to meet the teaming aspirations of Nigerians. And I'm particularly thankful for Business Day for organizing this event and bringing it to the forefront of the conversation around the Nigerian economy. I do have a short slide, a presentation slide that I'd like to just quickly speak through. Thankfully, I think a lot of the heavy lifting has been done by Andrew, so I may not have to speak to a lot of the things that I'd wanted to. So can I share my screen?
Yes, sir. You can share it.
Okay, so I think the conversation, if I extend the conversation that we had earlier in the presentation by Andrew, I think clearly we would all agree that the pension fund legislation in 2004 is probably one of the most significant legislations to come out of Nigeria in the last half a century or so. We've seen significant accumulation of capital, 11 trillion to be exact, Andrew. And we're seeing coverage continue to increase on an annual basis. So right now, roughly about 9.1 million Nigerians are covered by the pension industry. But I think the conversation today clearly is one that we need to progress from these numbers. Whilst it's easy to beat our chest that we've made substantial progress, and indeed we have made substantial progress in terms of pension coverage for the Nigerian industry. But I think the challenges we face as an industry are quite significant, and those challenges have far-reaching implication on the vast majority of Nigerians, 9.1 million Nigerians to be exact now, and that number continues to go on an annual basis. And I think the decisions we make now. And we make tomorrow, and we make in the very near future, will have far-reaching implications on how their retirement life looks like. And in looking at these numbers on this slide, I think two key numbers I think are very critical for. And this is really just extending the conversation with Andrew. The first is that figure, which looks at the coverage, and which is really just a fraction of the working community in Nigeria, probably less than 10% of the total working community, both in formal and the formal sector. The second is this, and this speaks to the conversation earlier about capital formation in Nigeria and the impact or the lack of impact that is having on economic growth. Currently, our pension assets to GDP currently sits at about 7%. When you compare that to developed or developing economies like ours, Chile, South Africa, that suggests that we still have a significant way to go. And unless the rate of capital formation increases significantly, then we are unlikely to see a significant growth, as well as counterpart funding coming from international investors into Nigeria, help drive growth and help drive prosperity for the average Nigerian. So that's one. This slide really just speaks to how we've seen the industry grow. But I guess what is important also is that that rate of growth is tapering off. And if we continue to rest on on our laurels, then we would see significant decimation in industry and a loss of confidence. So clearly, a lot needs to be done today in order to reverse that trend. And this slide, I think I've spoken to some of these things, and Andrew also alluded to them. So penetration rate is still low, 11% of our labor force, and we're still roughly about 7% of GDP. That needs to grow appreciably in order for us to have an impact on Nigeria and the Nigerian economy going forward. We've talked about the persistent devaluations we've seen over the last 10 years, over the last 60 years of this country, and that has a major impact on pension assets and the ability of our contributors to live the sort of life they've dreamed of when they retire, because Nigeria is so dependent on imports, as we all know. Real returns, I think, is one major issue, and I think will be a topic for discussion, extensive discussion at this meeting. There's a predominance of government paper in our assets allocation as PFAs, and I think that is one area that should give us cause for concern, but also suggests that there's a lot that we need to do in terms of market development. There's a lot that we need to do in terms of diversifying that asset base to ensure that longer term we insulate against inflation, but we also set the tone for consistent and inclusive economic growth going forward. The industry, given the sort of assets that we accumulated, has the capacity to do that, and we must, as an industry, stand at the forefront of that activity. I think investment returns is one that it's a small area, but it's also a very important area, because it then speaks to our ability as an industry to ensure that what we put out there as returns are verifiable and meet whatever standards that are required. And I think that is work that is ongoing between PENOP as well as PENCOM9 in terms of improving the quality of investment reporting. In terms of the areas that I think we've done well, safety nets for over 200,000 retirees, but also that net hopefully will extend to the 9 million contributors that we have now. But clearly, there's a lot we need to do to ensure that that safety net is guaranteed for those contributors. Delivered consistent returns on a nominal basis, inflation adjusted, probably lower, but that is work that that we need to do to ensure that that is consistent going forward. Where we are, post-COVID, or the immediate impact of the COVID of the pandemic. I think we've spoken to a few of these things, but clearly registrations have tapered off significantly, especially this year. We're seeing higher withdrawals from the scheme, which from an industry standpoint, one would view as a bad thing. But I think from a confidence building standpoint, it then suggests that the industry is able to help meet some of the challenges our contributors face, and these challenges are inevitable. People will lose work, lose their jobs, but the industry has been able to provide some level of support for them, and a platform that allows them, build off of, whilst they're looking for work. So yes, there have been positive developments from the pension space, but there's clearly there's work that needs to be done. Now, moving forward in terms of where we see or what we think the industry needs to do to drive growth and also drive that inclusive growth. going forward. As an industry, I think from an operational standpoint, there are specific things that we need to do to ensure that our ability to serve our clients and ability to acquire new clients is enhanced. So our focus should really be on, how do we reduce the cost to acquire and how do we reduce the cost to serve? And clearly, the only way to do that is, via technology. So it is important that we continue that journey to digitalizing the pension economy and ensuring that access is given at a low cost to anybody and everybody that's qualified to have a pension in Nigeria. I think business continuity planning is one that, as an industry would continue to pay attention to. And, it's an area that the regulator is also very passionate about because, our ability to meet the needs of the 9 million and growing, population that we serve is tied to, the strength and resilience of the business of the pension community. So clearly, those are areas that we need to continue to work on. We've seen the transfer window open in the past 2 weeks, and I think that singular event, our hope is will drive these two activities, digitalization of the pension economy, and just us consistently finding ways to improve the cost to acquire as well as the cost to serve our client base. I think structural changes that need to happen, and I think Andrew spoke extensively about this, so I wouldn't spend too much time on it. I think clearly, we have 22 odd operators or 32 odd operators in the pension space. And, that number continues to shrink on an annual basis as consolidation happens within the industry. And the sense we get also is that, with the opening of the transfer window, it may first further consolidation. And I think this shouldn't be viewed as a bad thing. I think it should be encouraged, because what it then means is that you have players that have significant capacity to drive growth, but also because of economies of scale, are able to return some of those benefits to contributors in terms of lower fees, for instance, but also higher returns to shareholders. So it's a win-win for all concerned. The second one, I think, is probably the most important, which is really asset class diversification. So as Andrew mentioned earlier, there's a predominance of government paper in our asset allocation as pension funds. So roughly about 67% of our total asset allocation is tied to investments in government paper. Clearly, that is not sustainable. And clearly, that allocation is not one that will drive the sort of inclusive growth that we're looking for the Nigerian economy. And so that needs to change. We're also, that asset allocation is predominantly focused on investing in Naira assets. Whilst that is great for national development, it certainly doesn't necessarily insulate the average investor from the consistent currency devaluations we've seen over the last 50 years or so. So clearly there must be a way in which we're able to at least provide some level of hedge to contributors and ensure that that lifestyle that we promise is one that they're able to achieve when they do retire. I think collaboration with policymakers, I think, is inevitable for us, given the size of assets that we manage and given how catalytic, if those assets are invested in the right way, in the right places, that can be for a country like Nigeria, and how we can use that to also attract investments into the country, or counterpart funding into the areas that require significant investment in Nigeria. And I think the industry needs to be a lot more collaborative, and industry needs to play a leading role in engaging regulators, legislature, the executive arms of government, as well as entities that are able to help provide that catalytic finance to drive growth going forward. So one of the things that we talked about, we talk about consistently about the Nigerian economy is the size of the informal sector. And clearly, for growth to be inclusive, that informal sector needs to gradually be moved into the formal space. One of the ways in which the government had sought to do that, and indeed our our regulator PENCOM, is the micro pensions plan or micro pension scheme. I think the ideas and the intent, I think, very laudable, but I think we need to reconsider the model and hopefully refine the model into one that makes it easy to, the cost of client acquisition to be easy. Also easy for potential contributors to join the scheme because they see the benefits and they see potentially how this can help them improve their financial future, if you like. So I think that that model or that plan, the micro pensions plan, is one that the industry together with the regulator needs to critically look at in order to rework it, to ensure that it's able to deliver the promise that it came with. And the final point is really around socioeconomic impacts, and I think it's one of the most critical for this conversation that we're having today. As I mentioned earlier, we, as an industry, the bulk of the assets we manage are invested in government paper, and it is really not because we do not want to take risk. We struggle oftentimes to find assets to invest in, but we also struggle to find asset classes that have been where investments have been packaged in such a way that it makes it easy for us to provide that capital to invest in those projects. So infrastructure is one area that as an industry, the regulator has increased the allocation for us, but we struggle to find assets to invest in because those assets need to be moved from their current state into a state that allows us as investors make investments in them and provides the comfort that we require to make those investments in them. And I think that's an area that as an industry, we need to, there's a lot of work the pension industry needs to do in this area. We have, over the last few years, over the last couple of years, looked at various structures that would allow us to make this investment. We've engaged with the industry, the financial services industry, in terms of really finding ways in which we can collaborate on this. But I don't know that we've been successful. We certainly haven't been successful. And I think we need to do more in this area. I think for growth to be inclusive in Nigeria and for us to be catalysts to that growth, it can't be by investing in government paper. It has to go beyond that. And I think government also has an important part to play in this, in providing the right sort of environment, but also providing the right sort of guarantees and safety nets that allows the pension fund industry make interventions within those areas that are critical to national development. As an industry, I think it's also important, and this is really a fallout of the first point, that we continue to focus on how we're able to deliver real returns to our contributors and how we're able to safeguard the investments, not necessarily in terms of just the capital safeguards, but also ensuring that from a real return standpoint, we're able to deliver that to them and ensure that those aspirations they have for retirement are met. Collaborations, I think, are also very, very critical for us, and collaborations with entities like NSIE, like InfraCredit, and us just using those collaborations to continue to develop the markets are critical for us as an industry to survive. I think one of the things that Andrew mentioned earlier is that whilst we sit on a lot of capital, we cannot take that for granted as an industry, and we as a community need to understand our importance and our relevance to national development, and step up to those challenges and help drive that inclusive growth that Nigeria requires. I will stop there. Thank you very much, and I think that would be, my submission for today. Thank you.
Thank you so much, Mr. Odutola, for this engaging and impactful presentation. And we do hope to have more of you at our future event. Okay, to take us further in this inaugural edition of our pension conference, I will be calling on one of our knowledge partner in our knowledge partner, detailed commercial solicitor. He is in person of Abiodun Oyeledun to give his opening session on the pension funds and investment option, the current regulatory landscape. I'll hand over to Mr. Oyeledun to deliver your presentation. Over to you, Mr. Oyeledun.
Thank you very much, Sharon. And thank you, Mr. Iboga and the rest of the Business Day team. I would like to use a minute to appreciate the team in taking the battle in driving this discussion, especially in such times. As we've already mentioned, the healthcare sector during this pandemic has come under a lot of scrutiny, as well as our general infrastructure as a country. I'd also like to thank the audience, for joining this discussion, as the audience is a large part of the pension scheme that we're speaking about. You and I make up the contributors under the pension scheme in Nigeria. I have a few slides I would like to speak through. Sharon, can I share my slides? Hi, Sharon. Okay. So my task this morning is to speak through the regulatory framework around pension fund assets, and also, as Mr. Ibogun had mentioned, the investment of those pension fund assets. Next slide, please. Okay, and very briefly, the outline is going to cover the regulatory framework, some key drivers, investment options, which is where I'll spend most of my time. I may not have to dwell too much on statistics, as Andrew and the previous speaker had already walked us through current statistics. And I'll also touch on some issues and mitigations that may have or may not have been mentioned by the previous speaker. So in summary, and as some historical for our listeners, is that the pension reform started in Nigeria around 2004 with the enactment of the Pension Reform Act, and that was then repealed, and a Reform Act of 2014 was enacted, and that's the key governing instrument for the regulatory framework of pension funds, both contributions and investments. There are, however, some other ancillary regulations within the sector, such as guidelines that are issued for the key operators within the sector, the PFAs and the custodians, as well as the state pension laws, which basically governs how states implement the pension reforms that are required from a federal level at state level. And perhaps also more key is the regulations on investments, which the regulator PENCOM from time to time revises. And the current regulation is the 2019 amended regulation on investments. This slide just speaks to the framework in general in terms of the key entities that are within the pensions industry. You have the PENCOM, who is the commission and regulator of the pensions industry. And oversight of PENCOM is by the board, which is made up of, or which is meant to be made up of a chairman, the director general of the commission, as well as other commissioners and key stakeholders in certain industries. And the director, whilst the board has a general oversight over the industry, the director general is manned with the responsibility to oversee the day-to-day running and operations of the commission. The commission largely is set up to license the industry players and also regulate contributions and investments, and enforce the rules and regulations and prescribe penalties where required. Whilst the key players are the PFAs and the PFCs. The PFCs hold the contributions while the PFAs invest, and some sort of separation of responsibilities is there, perhaps to drive transparency and ensure proper use of the contributions under the scheme. Whilst contributions made into the scheme is done on behalf of employees by the employer. In terms of the contributions, the Act has introduced a defined contributory system within Nigeria. And what this means in plain English is that there is a specific limit or a specific minimum amount which is prescribed by law. Andrew had mentioned it earlier, and the actual minimum prescription is 18%. 10% of that is contributed by the employer, whilst 8% is contributed by the employee. And the Act also makes it mandatory for certain persons to make contributions into the scheme. And it's mandatory for the public service, and also private sector institutions with a minimum of 15 employees who are mandated to make this 18% minimum contribution. That notwithstanding, the rates may be revised upwards by an agreement between employer and employee. It's also very key to mention, as the previous speaker said, that there is a voluntary contribution system in which institutions with 3 employees or self-employed persons are allowed to join the scheme under the micro pension schemes. And this is perhaps the industry's way of trying to tap into the informal sector and ensure contributions are ramped up. Next slide, please. So some key drivers under the regulatory framework is growing the investment pool. The previous speaker has mentioned that we are currently at 11.3 trillion, as mentioned, as of August 2020. And driving this is the mandatory contributions under the scheme, as well as the need to tap into, as well as the PENCOM's drive to tap into the informal sector. I won't go through everything. I'll just touch on a few key things because I would like to keep to time as much as possible. There's a multi-fund structure which has now been instituted into the scheme under the reform in 2014. And this essentially is a framework where the contributors are divided into different cadres within the framework, depending on your risk profile and your age. So the older you are, you will be in a cadre where your the assets that your investments can be invested in would not be as risky as a younger person. There are tax exemptions under the law for contributions, just to further again grow the investment pool. It should be noted that where those contributions are withdrawn within 5 years of the contributions being made, they then become taxable. And this is perhaps to disincentivize withdrawal of contributions. Recently, the transfer window framework has been enabled, which means you can now transfer your contributions from one PFA to another and increase competition in the market. The previous speaker had spoken about the housing deficit, which we have in Nigeria. And the regulatory framework allows for investments in such assets, but not only that, it also permits a window where contributors can access their contributions in order to make payments for houses, so to speak. And this is important because not only must you have invested in creating the buildings or the real estate people are to acquire, but you also have to empower the population to be able to afford such houses. And this allows a window where you could have access to your contributions as some sort of equity payment for a residential mortgage. Draft guidelines on this has been released. However, the framework is yet to be finalized. Next slide, please. And the investment options, what are these? Just some general things to note. I wouldn't go too much as to each class of investment, but some general things to note. One is that regardless of the fact that ratings are required for investment assets, PFAs also have their internal due diligence process, and whatever rating an asset has is still subject to the PFA's internal due diligence processes, which is why whilst you are doing your ratings, it's also important to perhaps liaise or discuss with PFAs to understand their internal processes and what they need to see to make them comfortable to make investments. PFAs can invest in securities that are guaranteed by the federal government or the CBN. And another key thing to note is that pension funds can only be invested in instruments issued by entities that operate, that implementing the contributory pension scheme. And this is also, in a bid to drive contributions under the scheme. Investments can be made in foreign securities, and in light of everything that we've been discussing around the devaluation of the Naira, this is perhaps something that we need to look at in the coming future, and how we perhaps hedge the risk against some of, some of the currency risk in the assets PFAs invest in. The Commission will, however, from time to time, give guidance on how such investments may be done. And assets are generally required, as mentioned in the slide, to be listed on an exchange for secondary trading in order to create exits windows and liquidity for PFA investments. Okay, so investment options, I wouldn't walk through this, but it's just key to note that PFAs are allowed to invest in equities and also debt securities, which are issued by different sorts of entities, both public entities and private entities, as well as SPVs that are wholly owned by public entities. And also PFAs can invest in infrastructure bonds, as well as money market instruments of banks. On the slides, I've just tried to put in additional requirements under the regulations. Touch on one of those, which is for state instruments, apart from the rating, which kind of cuts across all investments that PFAs would make. State instruments would also require an ISPO, which a state must put in place for a debt instrument to be acceptable by PFAs. Okay, next slide, please. Okay, just to touch on the fact that PFAs can also invest in funds. These are equity instruments as well, or specialist funds such as infrastructure funds or real estate trusts and other collective investment schemes, whether open-ended or closed-ended. Next slide. Okay, like I mentioned, I wouldn't dwell too much on statistics. Previous speakers have already spoken to a large extent on this. We are currently at 11 trillion or so in terms of contributions. A large part of those contributions are invested in FGN securities, 66% as of August by PENCOM's reports. And it is, however, pleasing to note that contributions have increased by increasing year on 2019 and H1 of 2020. There's been an increase in contributions by members under the scheme. Another point to note is that currently there's about 30% of the population registered under the scheme, which means that there is still a massive room for improvements on contributions. Next slide. Okay, so some issues just to note is one, as previous speakers have mentioned, because predominantly investments by PFAs is in FGN securities, bonds and T-bills, there is a limit on the yields or returns which you can get from such assets. And in the current economic climate, it may be time for PFAs to start looking at other kinds of assets with perhaps higher yields or higher returns. And the only way to do this is, to be creative. And, we need to find a way to create such credits is already acting in that space to generate and unlock PFA investments into those critical parts of infrastructure that is required in order to develop the nation. There has been reported that we'll need about 30 plus trillion on an annual basis in order to fill up the infrastructure vacuum in the country. So there's definitely a need for other investment grade assets to be created. So PFAs need to discuss with financial services sector and also the legal industry, to understand what the regulatory framework would be. The other thing I will touch on is with respect to the need to also unlock funding for states. From experience, we've noted that certain states have issues tapping into PFAs because of the regulatory framework, which requires that their revenue must not be less than 50% of their current debt profile, including whatever amount they're trying to raise from the public, the investing public. As such, there's a need for the regulatory framework to perhaps be looked at. And if there are sufficient credit enhancements that de-risk the assets, then perhaps it would be time to make some changes or give some allowance to allow states to invest. I see that I'm pressed for time, so I would stop there. And once again, welcome everybody and thank the Business Day team.
Thank you so much. Thank you so much, Mr. Oyeledu. Thank you for your wonderful and insightful presentation. We do hope to have more of you, and we also do hope that the presentation slides can be shared so that we can deliver it to our teamy audience. And just to round up a bit, a lot has been said by Mr. Dutola concerning the micro pensions and the challenges and the opportunities locked inside. Also, Mr. Oyelu said in August this year, the micro pension scheme was about 11.3 trillion naira. So our next presentation is titled Micro Pension as a Tool for Lifting Millions Out of Extreme Poverty. And this presentation will be delivered by Mr. Tunde Andrew, the co-founder of Awaba. Mr. Tunde Andrew, over to you.
Hi, Sean. Can you hear me?
Perfectly.
Yes, okay. First of all, my name is Tunji Andrews. I know Tunde and Tunji are similar, but I will be going through this very quickly because of time. And the general reason is because we all know time is against, we've gone far. So I'm going to just go through everything in about 2-3 minutes. God help me that I'm able to do that. I don't need to explain micro pensions to anybody here. I'm hoping that the audience too also know how micro pensions work. It's largely for the informal sector. My name is Tunji Andrews again. I'm co-founder at Awaba. And what Awaba does basically is that we concern ourselves with taking financial services to the informal sector, and particularly micro pensions. So over the last 1 month or so, we have been actively on the field trying to sell the product to a few people with our partner, Leeway Pension. And we have noticed a few things. I would have shared my slides, but I'm pressed for time. So I think I would just go through the conversation like that. So first of all, I wanted to say one of the things I noticed, and it became more clear to me on the streets, was the Nigerian dream. What, of course, people would refer to as a difference to the American dream. Now, the Nigerian dream is, how will I explain it? It's a person walking on the road, and many Nigerians have prayed for this at one point or the other, believing that they'll be walking down the road one day, they will kick a bag and they'll open the bag, they'll see dollars inside, and they become rich. Or they would go into politics or go into illicit activities. And the reason for this a lot of the times is because many of them can't clearly see the difference between where they are now and what will get them to where they want to be. Just a comfortable life, not specifically being Aliko Dangote or anything. One of the numbers in my slides I wanted to share is the number of old people we have in Nigeria right now. It's a very small number, roughly under 6 million aged people in Nigeria. The particular and interesting thing about this number is that in 25 to 30 years, large Sorosuke generation right now will be in that retirement phase, and they will be aged, they will be older, they will be retiring. And for a lot of people who are in the informal sector, everybody here knows the amount of people in the labor force who are in the formal sector, either unemployed or generally just underemployed, or in the informal sector as artisans, bricklayers, people in the NURTW, the market women. But the general thing is that many of them, their income is directly tied to their ability to go out and work. So it is tied to their strength. So whenever they get to the point where they can't actively go out, it's over. They can't earn anymore, and that plunges them directly into poverty. The lucky ones amongst them who have had 6, 7, 8 children, hoping that one of them will be successful, tend to get that child to be able to take care of them. The others just basically become desperately poor. One of the things we realize on the streets is that, and I in speaking to a few of the PFAs, some here about micro pensions, I realized that the approach to the market is not the approach that will work. At least being on the streets, I've been able to realize that the streets need relationship. There is a reason why Ajo people still do the contribution that they do, where 12 people are together. So they say, me, I will collect in January, you collect in February, you collect in March, you collect in April, and the rest and the rest. There's a reason why that still works, despite the countless number of financial services, automated financial services, which can do the same exact thing without any risk, basically, and pay you the lump sum at the time you've agreed. The same exact scenario, but they would rather have it in the situation whereby we gather. There's a reason. It is because they trust one another. You think they should trust the financial services, you think they should trust the banks, but it's not entirely like that. They would rather trust EABC that is down the road than trust a financial service provider who is coming all the way from Lagos, Abuja, or wherever they might be coming from. And that is the thing we realized, and we have capitalized on the trust. So what we've done is we've gone into the communities. Technology is important in using USD and all the Momo services, but we must start with trust. We must start with engaging, knowing these people, having conversations, being able to relate with them one-on-one. In this 1 month, we had 712 people. It's a very small number, but we look to, in the year 2021, at least double the existing number of micropension accounts we have today in the country. This is not something we believe that is going to defeat, but we know that the way to do it is going through trust, which a lot of financial service providers who have been able to detail themselves to the to the informal sector have used for many years. I wouldn't do more than that because I have a lot of slides that I could share, which we've been able to build that trust. This is the much I can go through today. I'm sure that Business Day will be able to share my slides in the coming. But I want to thank Mr. Frank. Thank you very much, sir. You've always been a huge mentor and a supporter. Thank you very much for allowing me to do this, and thank you for the Business Day team. I really do appreciate this. Thank you very much.
Thank you, Mr. Sunji Andrews. I hope I got the name correctly this time around. Okay, thank you for wrapping up your presentation at a very short time. And we do hope to have more of you and have more engaging discussion with you. Now, to take us further into this very interesting and engaging dialogue, we are going to our first panel session of the day. And the title of the panel session is The Future Nigerian Pension Fund Industry Landscape and Dynamic Lever. And the moderator of this panel session happens to be no other person than Mr. Femi Oladeyin. He is the partner at Gentle Capital Partners. I will hand over to Mr. Femi Oladeyin to introduce the panelists and also take over the discussion. Over to you, Mr. Femi Oladeyin.
Thanks very much, Sheung. Good morning, everyone, and it's an absolute pleasure to be here this morning and to actually introduce an interesting panel. And I think the panel is quite interesting because I personally know a couple of the people on this panel, and they come with significant experience in the pension space. The first person I would introduce on the panel is Oguchi Aguda. Interestingly, Oguchi and I were on a panel last week, basically discussing the future of the Nigerian market and how the pension market was a critical path of that market. Oguchi is the CEO of the Pension Fund Operators Association of Nigeria and has played quite an active role in the devolution of the market. He's an experienced financial person, and I think that the pension fund operators have actually done fantastically in attracting Oguchi to play that role. So Oguchi will be one of our panelists today. I also have Dumebi Obodo. Dumebi is the CEO of Chams Access Limited. Chams Access are technology drivers, or basically very active in the technology space. And they will be, he would be, a key part of how we discuss the future of the industry and how we think things would be driven. I also have Idu Okusa. Idu is the Managing Director, CEO of Access Pension Fund Custodians. I think if you recall when I think it was Wale who was speaking about the importance of the critical parts of the industry and how the custodians have played an active role in engendering confidence in the pension market. And I'm glad to have Idu on this panel. I also have my former boss, actually, Funsho Doherty, who's the Managing Director of Pension Alliance Nigeria. Funsho, it's actually a pleasure to have you on this panel, and I'm glad that we'll be able to glean some of your, age-old ideas on how to continue to drive the industry forward. Good to see you. I also have another former colleague of mine, Dakwaki Soria, who's Managing Director of AXA Mansard Pension Managers on this panel. Dakwa also has several years of industry experience in the space. Now, I'll set the tone and we can dive right in once that has happened. If you listen to what Andrew had said when he was talking about the economics and the demographics, it's amazing that all those numbers, I was having a chat with Okusa last week, and I said to him that, with Oguche last week, and I said to him, it's amazing that the same conversations we've been having about the Nigerian economy for 25 years are exactly the same conversations we're having today. I mean, as a research analyst 25 years ago, we talked about the same thing: stagflation, high inflationary environment, low capital formation, low, investment in the market, a currency environment that's extremely unstable. You almost have like a potpourri of negative drivers for economic performance. And you then would look back and say, in the middle of all of this, we've had a rapidly growing economy. And also worse, we've had a rapidly growing population. So when you look at the rate of our population growth and the average rate of GDP growth that we've seen, you almost have the feeling that we're sitting on a long-term keg of gunpowder. For the economy to continue to drive the sort of numbers that is required for the growth to happen, it's obvious that we need a lot more capital formation, and not more investment in the real space. So, setting that tone, it's important that we understand the role that the pension market plays in that capital formation. Unfortunately, the evolution of the market and the need at the beginning to basically build confidence in the market has meant that regulators and players have had to take very low risk. They've had a very low risk threshold, which at the formation of the market was important, given the fact that Nigerians generally distrusted anything that was government, and to probably a larger extent, the pension market actually came out after the second round of bank failures that we had. So there was significant distrust in the market, and the industry necessarily needed to provide a higher level of confidence and security to the market. But we're where we are today. It's 2020, and we're looking at a future where we're saying, is there significant scope in the industry to innovate and find more creative ways of driving value? And I think I would love to open this conversation with Oguche, who actually sits as the CEO of the industry pressure group. Just let's have your thoughts on this, Oguche.
Thank you, Femi. I think you hit the nail on the head, and I usually say that there is a journey in the evolution of any industry, and Nigeria's pension industry has evolved over the years. So many people always point to the fact that pensions are not doing much, pensions should do more. And we agree with that, I agree with that, but I always like to point to the fact that pensions have actually done quite a bit. So if you look at those 9 million people who before then didn't have any way of getting their pensions after they retired, There was no structured pension system. So the CPS, the contributory pension stream, since 2004, has actually done a lot. It has helped to create an industry, an investment industry. So many investment professionals have come into the industry. The industry has deepened the market, has helped to just kickstart the bond market. The bond market was practically non-existent before the pension industry came. And then the industry also funds a lot of government borrowing. So in that regard, I said the industry has done quite a lot. In the last 12 years, we've had about 3 recessions, starting from the 2009 global recession, but none of the players actually failed or collapsed, or nobody has lost their money. So I think the industry and the regulator has done well over that time. But I think it's now time to move into the next step. At the beginning of this year, someone called this decade the decade of the alternatives, and I agree with that. But what we need to do is, how do we begin to invest in those alternatives in a safe way that ensures that those people that have put their trust in the industry do not get the short end of the stick? And that is where the conversations need to go. And that's what the PENOP and the industry is pushing towards, to find safe alternative investments, to be able to invest some of these funds that we can be able to get double return, the financial return and the social return. And that's what we are pushing to. But so just in summary, saying that we've done a lot over the last 16 years, we need to do more. We understand that, and we are gearing towards that. Thank you.
Thanks, thank you, Gucci. And I think that is quite a good perspective to have. Just that forward-looking perspective. But I still want to just look back a bit before we kick that button forward. And I would probably like to bring Dapo into the conversation now. In the last 10 years, what would you say have been the most important drivers of the growth of the industry, and how do you feel that those drivers can play any role going forward?
All right, thanks a lot, Femi. I think one must acknowledge the role that legislation has played, because this industry came into being as a result of, I think, the appropriate legislation at the right time. And that's one of the things that has influenced what I think has been a remarkable rate of compliance by both the private sector and at least the federal public sector. So that's one. The other is, I think over time, even though there may have been, perhaps some level of discomfort by contributors at the start in terms of looking back at the history of the pension industry and being somewhat concerned about how this particular scheme would turn out. I think there was some understandable measure or level of cynicism, which I believe that over time, with the industry's track record, we've been able to demonstrate that this current scheme is a far superior one to the one we used to have historically. So that has also engendered increased confidence in the scheme we operate under today. In addition to that, I think the realization that there's a need for a stable long-term pool of investable capital in the country, which can be deployed towards higher macro objectives, has sort of seen or perhaps triggered the realization in different actors that this is really something that ought to be supported. It's something that we all have to do what is necessary to make sure it is sustained and that it works effectively over the long term. So I think some of these factors have contributed to increased confidence in this industry and therefore higher levels of compliance. That's not to say there are no shortcomings. These are shortcomings that I think some of the earlier speakers have spoken about. But I think increasingly, as we demonstrate the positive impact that we can have on the lives of workers, as well as at the higher macro level, I think more and more participants will be encouraged to be part of this scheme.
Thanks, Dapo. And so, I hear you. I think that for so many other, contributors. I think I was having a conversation a couple of weeks ago about this briefly. One of the concerns as a contributor, for example, that I've had with the industry is that, you know, that risk return trade-off that became the very bedrock of the industry, that obviously contributed to the confidence that the industry had. For the savvy contributors, there was always that frustration. You basically look at your contributions and the fact that the industry was more or less constrained to invest 80% of your contributions literally in government securities, who more often than not were giving you negative returns. The question then is, given where we are today, and I wanted us to spend a few, 10 minutes talking about the past, and then we can then look forward to the future, and hopefully not, dovetail into the next panel. But the question for you for sure is this: especially for the savvy investors who have had, probably have alternative investment portfolios and are comparing that to what the pension pool has been able to deliver to them. And then when you then make the mistake of trying to dollarize that investment, you just realize that you're probably poorer than you were, 2 years ago or 3 years ago. The question is, could the industry have done a lot more in that space? And let's now start to look at the future. Is there some form of advocacy that can help the regulators become more comfortable with a future where investors can look at a more diversified portfolio, a more widely dispersed portfolio, and ensure that they can protect their contributions in real terms?
Great, thank you, Femi, and thank you to Business Day for this conference. Demonstrating leadership as usual in putting this together. It's a good question you ask. And actually, if you look at it from a historical perspective, even though we have been constrained to invest substantially in fixed income securities, typically government securities, pretty much since the beginning of the act, substantially, 70% or so, it's actually serendipitously turned out not to be too bad a thing to have done historically, right? And the reason for that is that, for much of that period, we were earning double-digit returns on the fixed income instruments themselves. The Naira itself was stable relatively against the dollar for much of that period. And so when you look at it in terms of value accretion over time, on balance, it's actually not been too bad. We've had about 3 periods where, you've had devaluations, right? And those have taken away a lot of the gains. But if you sort of look at it over the entire period, you'll see that probably for a Naira invested at the beginning of the scheme, you probably just about maintained the value in dollar terms, right? Just because rates on government securities have been high and the dollar for most of the period was stable, even though you gave back some of those gains. Now, the more relevant question which you ask is going forward, given where we are now, are we likely to have that luck that we've had historically going forward? And chances are, given everything that we see today, it's unlikely that that will be the case. Andrew has spoken eloquently about this in his presentation, and the fact that we appear to be in a financial kind of repression type environment. And certainly, if the environment of today continues for any length of time into the future, you can imagine that in real terms, the value of pension assets will diminish substantially, such that in about 3 or 4 or 5 years, actually, it could be a fraction of what it is today in real terms. So clearly, we are in a new phase, which has been recognized by others. And we need to really think about how do we address ourselves to this phase, because we're in an environment that is not necessarily hospitable to us in terms of the things that we can do with our assets. And we therefore must think more creatively about what it is that we do. So going forward, I mean, some of these, I don't think it's going to be rocket science. Some of the things that have been identified by previous speakers, including Wale, the current chair of PENOP, include things like finding a way to facilitate global diversification, which is a best practice way of managing pension assets generally. We recognize that politically that may be a bit of a tall order in the short term, but it's something that we must always continue to look at. It's best practice, and we must head in that direction ultimately. But more importantly, we should be looking for real return alternatives domestically. And I think that, what happens when, they say necessity is the mother of invention. So, when you move into an environment where, you cannot stay in a safe government security and just earn good returns, then you have to think more aggressively about what do you do. And so I know there's a lot that's going on in terms of at the industry level, at the PENOP level, PENOP subcommittee levels, looking into these areas of alternative investing. What are the alternative assets that we can deploy domestically that can give us a real return alternative? The good thing about some of these things is that they deliver a dual benefit, in the sense that, one, it gives us the opportunity to find outlets to deploy for real return, but commensurately, those investments then are also positive for the macro environment. So there's great alignment in that area if we're able to do it and do it successfully. And I think it could be a mutually positive, sort of self-reinforcing thing. One thing I will add to this is to say that in the past, historically, the approach of the industry had been more to kind of be passive, to sit back and to say, let's see what alternatives are brought to us, by other players in the market, and we'll assess them and whether they're good or not, and decide. And there's a role for that. But I think there's also a role for the industry to also take a more active approach, particularly in the kind of environment in which we are now, to say, how can we facilitate, rather than just be a beneficiary of some of these alternative investing mechanisms. And as Oguche and Dapo are aware, there are a couple of initiatives that are underway, in the industry, sort of looking at how, that can play out. So let me leave it there, and I'll hand back to you, Femi.
No, thanks for sure. And I thanks for those insights. I think we all understand that it's been an interesting period for the market and for the industry. I generally say to people that the year that we're in, 2020, probably if you're a Nigerian, right, it kind of summarizes the last 20 years of how the economy has played out, and how from an industry, from a market, from a national perspective, you've had to be very, very creative to survive the curveballs that the industry throws to you. And I think that's where I would like to bring Idu into the conversation. One of the things that 2020 has probably done for all of us is to, in a seismic way, change age-old paradigms as to both investing, as to strategy, as to evolution of an industry. The question for you is, I don't know if Idu is on the call. I haven't seen him.
I'm right here.
Oh, okay. So the question for you is this: how do you affecting your strategy on a go-forward basis, both from a tactical perspective, which is just reacting to what has happened in the year, and long-term planning as the industry evolves? What do you think are the key drivers for strategy formulation for you on a go-forward basis?
Thanks, Femi, for the question. Can you hear me?
perfectly.
Okay, sure. So if you recall, with the pandemic, we have had to change things. Everywhere you go now, you hear new normal, new normal. How do you adjust to this new normal? So you can't continue doing things like the old times. While our past is important, we have to find new and creative ways to survive in these times. So every company will have their 3-year or 5-year strategy set on how they plan to achieve stuff. But we've all found out that we had to go back to our drawing boards. Who would have imagined that we'll be having an online conference in 2020? In 2019, if someone had told you that there will be a time that everybody will have to sit in their offices or at home and join such conferences, you would think it will never happen. So I think for me, understanding that pension fund is long term, there's no need to like panic, because historically, the even with the pandemic, the industry is growing. There's still fresh inflows. There's still the returns, like year on year, the growth is like 17% on the average. 2 years ago, it was actually 20%. This year, we've seen the fund still growing. I think the bigger thing to do is maintain focus more on long-term investments. I believe that with the board of PenCom in place, we'll see a lot of new things happening in 2021. A good thing to have is this mortgage-backed like ability for people to use a percentage of their contributions towards paying for a housing. And if you think of the huge deficit we have in the industry, in the country, another thing that comes to my mind is infrastructure funds. But going by what happened by that NSAS, if you recall that the toll gate has been destroyed, and these are people's investments. So how do you go back to the people that invested in that infrastructure to tell them that because of NSAS, their monies are gone? I want to believe that there's insurance on most of this investment. So in clear terms, those investments will never, you never lose out on them. So for me, we need to maintain focus, be creative in coming up with new strategies to forge ahead. Don't do things like we used to do back in the day or even as like yesterday. And just don't, just maintain focus for me.
Fantastic. And I'm going to give you a follow-on question to that. Now, the interesting thing, like you said, is that we've actually seen people who maybe prior to this period were not IT savvy or computer savvy, today have literally become savvy. You literally have no choice. My mom now can make a Zoom call. She can join a Zoom meeting. Probably would never have done it in her life. But what that means is that the innovation that you are going to see in the next few years globally, and that's what generally happens. As you know, if you look at the history of the world, post any crisis, you just see this flurry of innovation that emerges. People thinking in new ways. If you look at the World War, if you look at the First World War, just people just becoming more creative. Now, the question for you is that how do you see innovation driving changes in that space? And once you're done with that, I think we can now start to talk to maybe who is the IT specialist on our panel. But I wanted you to just talk to us about how you see innovation potentially impacting the industry.
Thanks for that question. So for me, I always tell people that you have to continually reinvent yourself, especially at this time that things are no longer normal. In the pension industry, the only major thing we'll have to do to forge ahead will be through digitization, especially with the micro pensions. So think of the micro pensions. You can sit down in your home and do your transfer and do your contribution towards your pension. Employers too can even, they don't need to walk into a bank to make transfers. So online transfers, So it's just about this digitization. I also learned a few years ago that innovation is not about coming up with something new. It's just being creative with old ways and things you used to do before, and finding easier and better ways to be efficient at it. So I think the industry is ready for that new way of doing things. Even Peckham, our regulator, everything they do online. So they've increased the reporting, which is all part of the safety of the funds to ensure that people are doing what they're supposed to be doing back in their offices. And for the PFAs that are marketing people out there, you can't be there physically anymore. So everybody's on WhatsApp, everybody's on the phone. So I'm sure they have all come up with new strategies of marketing people. I noticed that there was an increase in the registrations, even in 2020. So for me, I think it's important to reinvent yourself, move with the time. Don't sit in your old ways thinking things are going to change. We're only moving forward. There are plenty of opportunities even in the middle of this pandemic. So find out what works for your company. You can't go to your shareholders and keep telling them stories because of the pandemic. You're unable to make your numbers. I think that digitization is the way forward for the industry to forge ahead.
Fantastic. So let's bring in the digitization experts. Before you actually come into, maybe let me just make a quick announcement that for anyone who wants to join the conversation by asking questions from this, the brain power on this panel is probably enough to light up a nuclear. You can join the conversation by going to slido.com. It's slido.com and use the code BDPEN. There's a hashtag before that, BDPEN, BDPEN, all in caps. So maybe, please, let's talk technology.
Can you hear me?
Now we can.
Okay.
Are you technology challenged?
Thank you so much. Thank you so much. And thank you so much, the panelists that have spoken so well. Technology is everywhere. I mean, we use, it's technology we're using to make this happen today. The pension industry is not different from the events that are happening around us. But with specific reference to the pension industry, we have to look at it from the corporates, which is largely around the contributory pension scheme, to the public sector contributions. I know some states also still pay pensions directly to pensioners, and of course the micro pension that has been mentioned quite a lot. So starting with the micro pension, we're talking about over between 60, 80 million people bottom of the pyramid. To safely say, yes, bottom of the pyramid that we can target. And then how do you reach out to these people? One way to reach out to them is to deploy human beings to reach out to the 80 million people. You and I agree that this is not possible. And of course, the cost implications will not make sense business-wise. So it's technology. How do you reach out to these people at the comfort of their homes? Can they contribute and be sure that their contributions go in the right, towards the right buckets, and at the same time, they are confident of the technology platforms that they're using. So of course, it's interesting the way the micro pension space is opening up, is evolving. A lot of innovations are coming up, not so much now, but a lot will be coming up in the next couple of months, couple of years. So it's also a good thing that the industry, the PENCOM and the players also have launched that sometime last year, I think last year or last 2 years, and it's coming up gradually, and we'll get there. Now, take it back to the public sector pension. Now, what you have in most states is a situation whereby teachers and civil servants retire and they have to come to the capital of the state every month to do verification. It's interesting to note that there's something called I'm Alive Today, proudly powered by Champs PLC, that ensures that at the comfort of the homes, these pensioners can stay there just to snap. Someone can help them, just snap their faces and then impute their BVN and the pension number. And they don't need to go to the state capital to get verified. And online real time, the pension board gets these verifications and know that these people are still alive. And that qualifies them to receive the pension for the month. So technology is helping us every day to save costs, to elongate the lives of these pensioners, to even have better and faster systems of reconciliation and the likes. And then with respect to the corporate remittance, a lot has been said around the corporate remittance. A lot of platforms exist today. We have EPCOS, we have Pension Central. We have quite a lot of platforms today that employers conveniently can remit the monies due to the employees without stress. So it's quite interesting how these technological platforms have helped us leverage this industry, deepen this industry, evolve this industry. Yes, 9 million is still a lot of work to be done, but it's also something I believe the industry can be proud of, considering the time the contributory pension scheme started, and then of course the things that are the evolution and the innovations that are coming up in the near future. So it's quite interesting. A lot of things are happening with respect to contributory pension and the micro pension space.
Thanks, Tumebi, and thanks for that. One of the things we seem to have agreed on is that the innovation and the technology would play a critical role in how the industry evolves in future. Now, the question for you, I interestingly, you know, I'm an investment banker, right? So my job is to help people, you know, drive capital or deploy capital, and it appears that your industry has somewhat dodged a huge bullet, and the bullet is that we haven't seen significant foreign interest in the pension market. Basically, I mean, attracting investment from foreign investors or people who see the pension market as a very good entry position into Nigeria from an investing perspective. Now, the question for the panel, and I would like, you know, both Oguche and one other person to talk about this, is that do you see the industry being positioned for new investment, especially coming from foreign investors? And do you think that is going to be something that in the next decade you have to start to think about? If you look at the banking space in Nigeria, for example, foreign banks haven't exactly done great in this market, but they're still there. They still play some role in capital formation. You have the stand charts, the stand big, not in the big players in the market. Do you see that as a potential? I mean, I don't even know whether to describe it as a risk, but is that a potential event that most likely will happen in the market? And what do you think current players should be doing in anticipation of that sort of foray of a foreign player into this space that could potentially be disruptive? So Oguche, since you are the gatekeeper for the industry, I think I will let you start first, and then we can have either Fusho or Dapo chip in.
Thanks, Femi. I think I'll go back to Andrew's graph. And if you see Andrew's graph, he spoke about how FDIs are decreasing. So the pension industry does not exist in a vacuum. So if FDI is increasing in Nigeria generally, it also affects the pension industry. I mean, there's been some foreign investments and some pension industries have some holdings by foreign funds, but I guess it has to be a general macro strategy to attract foreign investments. In one of my previous roles, that's one of my roles, to attract foreign investment. So if you look at ease of business, you look at what foreign investors are looking for, I think in the last couple of years, that hasn't even happened in terms of even being able to take their money out. Those that have come in from portfolio standpoint haven't been able to take their money out. So I'm aware that a number of people are looking at Nigeria as an investment destination, but we need to realize as a nation that capital is looking for where it's going to make money. And if yields, the environment is better in other African countries or other emerging markets, then the money that's come to Nigeria will wane, even though pension industry seems to be attractive on a standalone, but just general capital controls and things like that will always, in a sense, hamper that. So I guess it's really a case of what the investors are looking for. How long-term are they looking for? You mentioned Standard Chartered. They have been here since 1999 and they took a long-term view. So it's really how does Nigeria and perhaps the industry attract, maybe on a targeted basis? Do we want these sorts of people to come in? Do we think they can add value? Can we, one of the things Funchal has spoken about, even if it's from an investment point of view, as opposed to being passive, do we now begin to go out and say we're looking for partnerships? And I think that is where we are heading to in the next decade and in the next phase of our evolution. Thank you.
Thanks. Dapo.
Thanks a lot for the question, Femi. It's an interesting one. I think you ended the question with by asking whether indeed it is a risk, right? I'm not sure I see entry of foreign players as a risk, and I think there are several reasons. One of those is the nature of the scheme that we operate in Nigeria. Perhaps woven around that may be the sort of regulatory environment that we have again, which in my view may or will have implications for the ability to innovate. And I say that within the context of realizing that we're essentially a mono-product industry today, and the things we do are very tightly regulated. So there's perhaps in some way limited room for innovation as far as product development goes. However, where there's room to differentiate, as some of my colleagues and earlier speakers have suggested, is in the area of service delivery, with a lot of the discussion around digitization. There's room in my mind for innovation in terms of the approach to investment management as well, which is where I think some of these players could come in and make a difference. However, the question I ask myself is whether it is something the market is asking for. Would these guys really make a difference, in comparison to the local players who have been in this industry over the last number of years? I don't think so. I'm not convinced. Another issue I think about is when you think about foreign investors and people who have had experience in the pension industry, the global story, I'm not sure is all that positive, especially when you look at the more developed markets and the issues they've been dealing with in terms of providing optimal returns to their contributors and meeting their obligations in a low yield environment. Therefore, to some extent, I think a lot of these so-called potential foreign investors may have, somewhat of a philosophical, resistance or perhaps inhibition towards additional exposure to the pension industry. And I've had a few conversations with some of these players, and those are some of the concerns that they express. In terms of whether there are barriers to entry of this industry, I don't think there are really any insurmountable barriers. The capital requirements, I think, for most major foreign players, I think can be, quite achievable. However, a significant, perhaps, barrier that we have today may be what I think of in terms of, the time lag in terms of where these guys will be coming into the industry versus established players. I think this is an industry where over time we've seen that there is a significant early mover advantage. Though I would also concede that a player with significant capital and who is willing to pursue a consolidation strategy should be able to surmount that to a large extent. However, the added risk to that now is that whereas over the last perhaps 15 years, that could have been a good counter argument. Today, with the recent opening of the transfer window, I think there will be a major reconfiguration of this industry today. One of the things we are all watching to take learnings from is how contributors will respond. What will be, the impact of brand loyalty, for example, versus, looking at differences in performance as far as investment returns go. I think this may be a particularly fraught time for any major new investor to come into this industry, unless you're coming with some of these things like a strong, well-known brand in the Nigerian, which is something which I think is significant. It's a significant consideration in our peculiar environment. So those are my thoughts around the entry of foreign investors. There have been a few who have come in, actually. As you know, Actis came into the industry a few years ago. Even, there have been major local investors who have come in recently. There have been recent announcements by GT Bank, for example, with its transformation to a holdco structure and the clearly announced intention to enter this industry. Some of these challenges I've mentioned are things I believe they will have to deal with, as they play out their strategies.
No, thanks, Dapo. And I think that your views probably help us, move the conversation to where I really want to see some. I'm hoping to get some level of excitement. You talked about the transfer window. And use the experience of the transfer window that opened up in the telecom space, right? As much as there was a touted transfer window, they're not that significant. And that may be because of several reasons. I know that there was the joke, for example, that one of the brands spent more money on the adverts for the transfer window than the number of new customers that they got. The question, and this question goes to Funsho, is that two things that are very key for me as to the growth of the industry, and we're seeing one or two questions from those new enrollees, or the growth on the investment side. The question is that, yes, both of them are desirable, bringing more people from the 9.2 million odd contributors and growing that number significantly, or delivering positive returns, above inflation returns as a potential path of growth. Now, the question for you, Funsho, is this. In the unlikely event, in the unlikely world that you had to focus your attention on one of those two, which would be the principal one, and what level of investment would you put into that? So let me just clarify the question. Someone wants to know that there is a potential growth for the industry that comes from enrolling new people, and then there's potential growth that comes from portfolio expansions. Now, from a strategic point of view, let's assume that you were constrained to focus on one. Which would it be and why?
Okay, thank you, Femi. By portfolio expansion, I assume you mean the return on the portfolio and the growth that arises therefrom? Is that what you mean by portfolio?
Yes.
Oh,
That's what I assume.
Okay. I think that in answering this question, I think that I would like to sit on the fence and say that they are not mutually exclusive and must not actually be mutually exclusive, right? Because I think both are required and both are important for us as an industry, and for us as individual operators. I guess if a gun were put to your head and say choose one, I think investment return is important because in the long term, I think the whole industry is built on that. If people do not believe that the pension scheme adds value, then the whole industry, I think, is under threat. So we must sustain that. And I think that's part of why the current discussion around the repressive financial environment, is particularly resonant with most people. It's almost an existential issue when you think about it for the whole industry. But beyond that, I think growth in enrollees is also key. I think it's important to continue to drive new business. Of course, there's the risk that with the transfer window opening now, that the focus is going to be more on sort of internal rivalry and internal competition, trying to win customers and so on. And a lot depends on the way that plays out in terms of, is it a high impact event or is it a low impact event across the industry? I mean, the transfer window. A lot will depend on the policy decisions and certain policy choices that the regulator can make, can actually transform it from being a low impact event to a high impact event. And it's only time, I think, that will tell. So in answering your questions, I think I'm firmly on the fence. We will continue to do well for our customers, delivering good returns, but we'll continue to look for new customers.
No, thanks, for sure. I think that one of the things that probably we need to give some thought to. Customer acquisition can be quite tricky. You need to then ask yourself the question that, have you taken the cream of the market already? And are the new people coming into the market probably new long term? I was reading a case study on the Harvard Business Review a couple of days ago, and it talks about how the card system or the debit card market evolved in the US. Trying to decide whether do you go and focus on the black market or do you focus on the mass market, the guys who would only pay $20 a year. And finding that trade-off is always going to be very important for the industry. At some point, the cost of acquiring one customer may not be marginally, better than the revenues that you are likely to get from that customer. But that thanks for that question. I have a question for our techie brother. Someone is asking that is that something that is accessible to all RSA holders today, or is that something that the industry is looking to develop even further? Do maybe you're on mute.
Yes, sorry, Femi, I lost you a bit there.
Okay. So someone asked, I suspected my internet was a bit unstable. Someone is asking if the I'm Alive platform that you spoke about, if that is something that's generally available to all RSA holders, or is it something that you're marketing to the industry so that it can become a standard for people going forward?
Yes, it's available. It's very much available. So the idea is to engage the different states. We are working with quite a couple of states It's a pretty simple application on the Play Store. You download it, and of course, we expect that the older folks may not be as tech savvy. So we expect maybe the young children to help them download it, and then you just take the picture, impute your BVN, and then of course impute your pension number, and that's it. It's not difficult, but it's not just something somebody can do on an individual basis. We're also working with the state government so that they can have a back end where they can get this report real time in order to verify that this particular person qualifies for the monthly pension. So it's available. It's been on.
No, thanks for that. Look, I think what is clear is that innovation is central to the industry evolving, even as regulated as sometimes I think it's over-regulated as the industry is. There is still that room for innovation. And look, I know that your from the pen up perspective, advocacy is one of the key drivers of the industry, just advocating and helping the regulator come to terms with what is real, what is a real situation in the market. We should start rounding off in the next few minutes. So the last question I have for you guys, and I would like everyone to just say one thing about each of those. If you had one big, audacious, hairy idea for the industry, what would that be? So over the next decade, you just had one big seismic idea for the industry, what would that be? I would love to start with Okosa, please. I would love to start with Idu. Idu, you're on mute. Idu, you're muted. Can you hear us? You're muted. Okay, whilst she unlocks her voice, Oguche, please, can you take it?
Thank you, Femi. I will sort of take you up on that and do more than one. So I've got a couple. And this flow with sort of our industry strategy. I think for one is for the industry to really be a driver of economic growth. So we want to see airports, we want to see railroads, we want to see roads, we want to see power plants being funded by the industry in a structured manner whereby, the cash flows are certain, the structure is certain, and is bringing a return to the contributor. So a double return of financial and social return. We want to move towards impact investment. Second thing is, to move that number from 13 to 15% of the workforce to about 30 to 50%, so more people to get more people into the net. Another thing is to be able to connect more Nigerians, especially diaspora investments, and to use pensions as a way to bring in foreign inflows. And I think the fourth thing is for the industry to be able to invest a portion of its assets offshore. So these are big, hairy goals, and these are part of our strategic plan also. Thank you.
I think you just summarized your KPIs for us. Dapo, can you take it?
All right. I thought Oguchi was going to mention all the ideas we've been discussing, right? So let me mention one he left out, right? So it's around, making obvious impact in a way that, it benefits the country in general, but our contributors can also see as, benefiting them in a tangible way during their active lifetimes, during their active working life. And it's this idea of housing. It's a knotty issue which we've been grappling with for some time now. And I think it's something that we really need to cast our attention and minds towards actually solving. And I think it's quite achievable in the short to medium term. So my big, scary, audacious goal would be to find a solution for the housing deficit that we have in Nigeria, using the investable capital in the pension industry as a catalyst to drive that economic imperative.
Thanks, Dapo. Mr. Doherty.
Okay, thank you, Femi. So I'm glad you asked this question. Actually, for me, I would just highlight one, and it is probably truly an audacious goal. But if I think about the pension industry today, 11 trillion long-term assets is about a half or so of banking sector deposits from nothing 15 years ago. And clearly the trend in growth is higher than the banking industry. So we have the scale and we have the tenure of our investments and the flexibility really to make a long-term impact. So if I had to pick one area for us collectively as an industry to impact, if we as the pension industry could in some way positively catalyze the change in the Nigerian economy from a mono-product economy, i.e. only producing, well, not mono-product, mono-export proceeds economy, oil, to one that has more than one, maybe three, maybe four or five legs or pillars for the economy to stand on. If we can play a catalyzing role in making that happen, I think we would have done a great thing. Because if you look at the currency crisis that we have, anytime our economy tanks, typically it's as a result of a currency crisis, which typically is linked to oil. And that's been the case in the last three big recessions that we've seen. And you can go back through time. And I think we have the potential to do it. We have the skill, we have the capital, and we just need to put our heads to work and then work collaboratively. So this is my one idea. And actually, there's some work going on it as we speak.
Fantastic. Thanks so much, Funsho. Let's round off with Dumebi.
Thank you so much, Femi. Mine will be for the industry to adopt massive deployment of technology. Massive. When I use the word massive, I'm a contributor today. How do I know? I don't want to just get an SMS every month from my pension fund administrator telling me this is my amount, the amount I have today in my pension contribution. I should be able to query to know what are the rates like. Give me an idea of what you invested in. And then I can compare and be sure that I can get, I'm not able to get something better elsewhere. How would I, as a contributor, compare what is being done for me in a particular PFA and the other? How would the housing that was mentioned, how would someone who plays in the real estate space see Mr. A and project a certain percentage over the next 5, 6, 10, 20 years? That this thing going at this rate, I should be able to sell that Mr. A house in Banana Island because going by this rate, I believe this person can pay. How would the regulator, without sending an email, without calling anybody, know exactly, compare the rates that are available out there against the rate a particular PFA gives and compares it across the industry? How would the FDI man, the person who wants to make an investment into the country, have the level of transparency and see that if he goes by this rate that the pension industry is churning out, if he puts this particular amount, or we create some kind of cross-sectoral leverages, how can we make more money for the pension industry and the stakeholders therein? So how would you deploy massive technology cutting across these areas that have been mentioned to create that monster of a sector that we'll all be proud of. So that's the vision of Pension Central. Thank you.
Thank you very much. I mean, I want to thank the panel for such a fantastic, time. I promised you guys when we're starting out that the brain power that we had in the room was significant, and I believe that this has been such a useful time for all of us. Look, my parting comments are this. Look, I look at the industry from the outside. I've always believed that I remember sitting in a room when my previous employers were going to come into that space, and us just thinking about from a strategic point of view what this could mean. And we always use the case study of Chile as a platform for our pension industry, seeing it becoming a major catalyst. Interestingly, when I hear this housing conversation, it just gives me these goosebumps, because I remember writing a paper on the fact that a critical path for the pension market was to become a big driver of the housing market. So why can't I get a mortgage using my pension fund as security for that mortgage? And I'm glad that these conversations are now in the mainstream, and they should drive continuously. I want to leave you with one thing. We had this conversation with Gucci last week, and what I said is that the pension industry has to detach itself from the Nigeria that we are used to. And it's something that Funsho alluded to in his last comment, which is that we need to start to think of ourselves as catalysts for Nigeria's future, because that future is critical to the sustainability of your industry. The pension industry should become the number one employer of choice in Nigeria, as I describe it. Basically, if I have the biggest, craziest idea to develop an industry, the pension market should be the guys who fund that idea, ensure the corporate governance is right, because you already have the best corporate governance in the country anyways. Just being able to take all of those learnings and flood the market with it would be significantly important for us for the future. So once again, I want to thank you, each and every one of you, for joining us on this panel. Thank you very much, Jumebi, for your insights on technology. Thank you, Funsho, for your insights on the industry. Thank you, Dapo, for your well-crafted ideas. Oguche, we still have a lot of things to talk about. I know that as soon as I'm talking to you, I'm talking to Funsho, Dapo, everybody at the same time. So let's continue that discourse. And for you do as well. It's a pleasure. Thank you very much. I will now hand over back to Sheung, and hope you guys have a fantastic day.
Thank you very much.
Thank you, Femi. Thank you, Business Day.
Shall I? All right. Thank you so much, Mr. Olade. Thank you for the way you handle the conversation. And on behalf of the publisher, Business Day Media, Mr. Frank Aigbogun, I would like to say a big thank you to all our panelists and our wonderful moderators. But I think my own take home from all the discussion is simple. We need to find safe investment opportunity, which is very critical for the Nigerian pension industry. And also considering that we operate in a very peculiar operating environment, long-term investment seems to be the way to go. I know that the policy holders and decision makers are listening, and all this will be taken into consideration. Thank you so much for every one of you. And I want you to enjoy the rest of the conversation, because we are not yet done. We are moving to the last and final panel discussion for today. I'm very sure that the first panel session has been so engaging and impactful. I'm also too confident and too sure that the next panel session will even be a lot more engaging. And because of that, I want to introduce the topic of our second panel discussion is visible investment option for Nigeria pension fund, the opportunities and the challenges. Like growing up, I remember, they said for a great and effectual door is open by many adversaries. So which means with the visible investment option, there are opportunities and there are challenges. So I would like to introduce our moderator for this panel session, and he is no other person than Mr. Babajide Fadaunsi. He's an investment banker with FBN Quest Merchant Bank Limited. Over to you, Mr. Baba Jide Fadaunsi. Candidate, follow the procedure by introducing all your panelists, and I hand over to you.
Thank you very much, Sean, and thank you very much, Business Day, for putting this together. I think it's coming at a time where I think the market needs this. In terms of, I mean, it's been said several times this morning in terms of the skewness of pension assets towards government securities. Coincidentally, also rates are pretty low. It's, I mean, going below 10 now. I think this makes this conversation about where are we, what's the future for the pension assets. I mean, it's been discussed there concerning the likely issues we have with alternative assets not being well invested. Look, the pension industry ought to be the catalyst for the future of Nigeria. So this raises the question, how will this role be played? And I think we have a well-experienced and vast panel to discuss this. I will start by introducing the panel in no particular order, starting from Mr. Chinua Azubike, the CEO of InfraCredit. We also have Mr. Adeni Ifalade, the MD of Crusader Sterling, and Mr. Babajide Ibirunke, the CFO of Batan, representing the issuers. And we have Mr. Bolaji Adeoye, a fund manager, managing partner, Consonance Investment Managers. And we have Mr. Amisu Idris, the MD of Investment Pension Managers. Thank you everyone for joining the panel. And just to double check, I think we have everybody on the call. Yes, and welcome once again. To kickstart the conversation, I mean, just to avoid repeating what several speakers have probably reiterated today concerning where we are and what the future holds for us, I would like to start with Mr. Falade to probably discuss, okay, I mean, the 2004 Pension Act, 16 years today, asset base at about 11.3 billion as of August, about 9.1 million people captured. The informal sector was introduced a few months ago, and we expect that to be ramped up soon. A lot of people consider that a game changer. I recall the previous panel, someone mentioned that that's the best, okay, I think that was Mr. Odutola, that's the best legislation in 50 years. So 16 years down the line, what would you consider to be the next quantum leap for the industry?
Yeah, I mean, thank you very much. You're very correct in your analysis. The contributory pension scheme came in 2004 with lots of hopes and also lofty objectives, most of which have been achieved. However, there remains some little things to be tweaked. The key things are that when the contributory pension scheme came in 2004, the objective was to encourage savings and also to mobilize capital. To that extent, the scheme has captured over 9 million workers to date. However, when you put that 9 million workers in the context of the total working population in Nigeria, which Elfina and PwC tells us is about 85 million, then begin to ask what has happened to coverage of the other people. What we know, what we have since found out, is that the informal sector, constitutes a larger percentage of the working population. In fact, it's estimated to be about 70%. So what that means is, to date, The effective coverage level is just about 10.5%. This is not unusual for a developing country because if you look at what happens in Ghana, what has happened in Kenya and Uganda, they also struggle to raise coverage level above 10 to 11% in format space. So the key game changer actually has been introduced, and it has been discussed by a number of participants today. It's just that it needs a lot of rework to remodel it so that it can achieve its objective. I think I also like to add that for other developed countries, like Chile, where we borrowed the scheme from, we were able to achieve a higher level of coverage. Chile, for instance, at the end of the day, after so many years of contribution, achieved 89% level of coverage in the formal sector and 68% in the informal sector. Brazil achieved 44% of the formal sector and 31% of the informal sector. Colombia, 91% of the formal sector, 26% formal sector. Mexico, 65% of the formal sector achieved after several years of contribution, and then 31% achieved in the informal space. So there is hope for Nigeria that if we rejig our micro pension that we have introduced some few months back, then we'll be able to also achieve what I think is the game changer. The reason why this is very, very important is, has also been mentioned by one of the speakers. The guys that are in the, that have not been covered, those guys, they are huge. And one of the things we're also experiencing in Nigeria is that there is longevity, and because of that, we are likely to be faced with a situation where, several years down the line, we have huge elderly population without pension plan, and that is very, very dangerous for the country, especially for the government in terms of the social responsibility. So the few inadequacies that have been experienced on the micro pension scheme now have to be dealt with. Things like not having enough trust in the scheme, irregular contributions, and so on and so forth. These are the next things that have to be dealt with by all stakeholders in order to bring all of these guys into the formal pension space. And once this is done, then the industry will be able to achieve the objective of even 20 trillion assets under management in the next few years.
Thank you very much, Mr. Falade, for the lucid explanation. Just to continue that conversation, let me go to Mr. Idris. So also, yes, he mentioned 20 trillion naira as a likely target in terms of where we might see the pension asset grow as in terms of quantum leap. Considering where we are as a country today, and I mean, we've seen various figures, $10 billion, $15 billion annually for the next 10 years to drive growth that is required. Is the pension industry really the game changer, or something else, or what needs to be done to drive the required growth? Because the last panel, someone mentioned the fact that this should be the catalyst for the growth Nigeria needs. But 20 trillion, is that a figure that can do that?
Thank you very much, Babajide. It's a very, very good question. And I think the industry has come a long way, though we're not where we are supposed to be, based on the numbers we have all heard. If you look at Chile, from where we borrowed this scheme from, where we understudied to implement the scheme, basically the pension fund administrators run the economy, from the construction, real estate, agriculture, and co. The pension industry is the real catalyst for the growth of Chile. So much so that they export funds to be invested in other economies like America and the rest. Yes, the confidence in the industry has grown tremendously from the implementation in 2004. We still have a very long way to go especially in the private sector. If you look at the percentage of registered clients we have in the private sector, if you discount the number of people that have double pins, because if you look at the 9.1 million pins that we have on our database currently, by the time you look at it critically, you find out that only 5 to 6 million RSAs are really good RSAs. So the rest have to be discounted. And if we go back to look critically at the way we have started the scheme, the state coming on to register onto the scheme, the private sector, you'll be shocked to find out that about 80% of private schools, clinics, that is private clinics, and hotels are still yet to latch onto the scheme. So if you look at that opportunity, the vast opportunity that we have, and the people that have not yet latched onto the scheme, by the time we do the things right, enough sensitization, especially in the private, the informal sector, where in the last 18 months, where all we have been able to capture is just 44 million naira in that space. So, and about 70% of our people are in the informal industry. So you can look up the size and the quantum of opportunities in these areas. So if pension fund administrators can act on, in concern with the PENOPS and the that is the National Pension Commission, who's our regulator, to really see how we can work with the public in policy implementation to talk for public sensitization, for people to know the advantages they tend to get if they register onto the, kind of take care of their own future through having retirement savings scheme. The 20 trillion naira is a far cry from where we can be in the next few years. I assure you, by the time we really do well to introduce, I think we have to introduce that product of, the informal sector, because the trust is not been there, because they look at us as one of those things that have been going through, MMM and co. That is going to, when you go to the market, you talk to people, that is how they feel. So when we come back to sit down and say, okay, look, let's introduce this thing, but let's use a different approach to how we introduce the market with this product. You can be rest assured within the next few years, and we sort out the use of technology, because one of the biggest stumbling blocks we experience from implementing these schemes is the area of, the use of technology. Because you cannot expect a person, an artisan, a teller, to leave his office or leave his working space to go and start joining the queue in the bank, to go and pay he wants to put in some money into his RSA. But by the time we come out with unique, inventions, ways by which these people, at the convenience of their working places, they can upload and make deposit into their account, and if they want to make withdrawals, they can do it. And so also engage state governors, especially those in the north. The northern part of the country, I think in the north, is only in the Kaduna state currently that is having a fully funded scheme. And even Kaduna itself, there is still a lot of issues to be discussed. So if there is going to be deeper engagement through PENOPS, the National Pension Commission, to engage with the state governors, so also better improved supervision from the National Pension Commission to ensure that all those private sector institutions that are supposed to be on this contributory pension scheme get registered onto the scheme and keep funding those RSAs. We can get there in no time. Thank you very much.
Okay. Thank you very much again for your perspective. But also important now, we've discussed aggregation of assets. I mean, how do you aggregate the required capital? Because that's a critical part of what we do, or what will drive the required growth. We would like to also speak to Mr. Adeoye now, and probably ask him this question that has to do with, at this point in time, the previous panel has also mentioned this in terms of negative real interest rate in the market, and for how long can this last? The jury is out on that. But going forward, someone also mentioned that this ought to be a decade for alternative assets. And I think that reality is catching on us very fast with the new realities of lowest interest rates. So for Mr. Adeoye, considering concerns that PFAs are largely exposed to limited asset classes, largely plain vanilla bonds and equities. As an asset manager, what do you think are the opportunities across sectors, asset classes available to PFAs, considering the regulation as of today?
Yeah, thank you very much, and thanks for having me. I think just to go back slightly, I think broadly the role of pension or the goal of pensions is largely to provide retirees with a decent income to maintain a basic standard of living. So in that regard, when we sort of look at the economy, I actually think, the first 16 years was, the pension industry did a fantastic job in accumulation of capital, ensuring that there is, broad-based trust and credibility within the system. I think the next 16 years is actually going to be a decade of collaboration. And when I say collaboration, if you look at the current economic state, right? I mean, inflation 12 to 14, Treasury bill sub 1. You look at sort of the large informal markets. You look at our large, debt assets. And the fact that, contribution as a percentage of our working population is still low, you realize that the pension managers can't do it by themselves. So we definitely think that there has to be significant financial education, even for the contributors themselves, so that they also understand the role of pension managers, but also the role of economic managers, and hold economic managers responsible as well, because again, pension managers can't do it by themselves. So broadly, when we look at opportunities in that context, when we look at opportunities, I would probably look at the opportunities in two ways. One is wealth preservation, and the other is wealth creation. Wealth preservation really, I think, has been the pattern for investment. I'll probably say over the last 16 years, for good reason, and it's probably going to be the same, for probably the next 16 years as well. Wealth preservation, basically, preserving the capital and also maintaining its buying power. So you'll see that a lot of the allocation will still remain in vanilla bonds and stocks, and rightly so. So, but on the other side, there's a small allocation, I believe, from anywhere by, from 5 to 10%, that largely goes into things like infrastructure, alternative investments. That is where I think a bulk of the work, some of the work has to take place, around the ability for pension managers to increase allocation into that particular, into the alternative investments market. And in terms of opportunities, I think the opportunities are beginning to show itself. I think, the pension managers have some allocation into infrastructure, into private equity, and even there's some risk products as well. But we do need to build out this market. For example, commodities market, those have to be built out, and also the real estate market. A lot of people have said a lot around housing. But building these markets require significant work at the origination level. Origination level basically means, you are basically building, the right infrastructure, to be able to sort of build, to be able to attract liquidity and build a well-structured market around that. So I do think in terms of opportunities, a lot of work still has to go. to improve the number of products that we have in the market, for private equity, for trade finance, for REITs, even asset-backed securities. So those are some of the areas where I think some work still has to be done in terms of asset managers, providing more products into the market.
Thank you very much. I mean, considering your experience with the asset class and what you think needs to be done, though, I mean, some people still raise concerns around what are the governance around things like alternative asset. How are this going to be managed? I mean, with governance not well probably articulated, it brings about trust issues, and we all know that trust is very important to development of markets. It is the cornerstone of it. Once trust is lacking, there are fears that opportunities will there has been reports that I mean, some people recently, there was a report by IMF that explained that a lot of the inflation flow into Nigeria might not actually be through exchange rates, might actually be through challenges with infrastructure. The supply chain within the country is not as strong as it should be, largely due to weak infrastructure across the country, which is impacting on prices and driving inflation up. And to speak about governance, I mean, InfraCredit has brought this into the infrastructure space and tried to more or less mitigate risks. So we'd like to hear from Mr. Zubike, what are his thoughts? I mean, what do you think needs to be done to attract pension assets to an asset class that you've worked hard to the risks?
Thank you, Babajide, and thank you, Business Day, for for such a unique opportunity to have these conversations, and also to share this panel with very esteemed panelists. So thank you. Firstly, I'll just talk about why InfraCredit existed in the first place. So we've been in operation for 3 years now, and the reason that the Nigerian Sovereign Investment Authority, in collaboration with other DFIs, set out to establish InfraCredit was mainly based on the need to allocate more long-term local currency financing into infrastructure from the local pension funds and also the insurance companies. And InfraCredit was demand-driven. When I say demand-driven, was because it was out of a survey that was conducted with the local institutional investors that the need for a local currency guarantee company that is able to provide the credit protection that is equivalent to the AAA rating of the sovereign, and therefore be able to build confidence in investors to allocate capital to an asset class that otherwise there were constraints in putting contributors' capital into. And so, when we started operations in 2017, we were essentially supported by the local pension funds by way of investments in the bonds InfraCredit guaranteed. I'm happy that Babajide is here of VADAN, because VADAN was the first example of a corporate with the benefit of our credit enhancement being able to access financing of up to 10 years in local currency from the debt capital markets, largely invested by the local pension funds. So that tells us something. It does tell us that industry has the capacity to innovate. It has the capacity to impact change. And I believe that, as the other speakers have highlighted, there's significant learnings that we can leverage on in really expanding the potential for impact. And when we look at infrastructure as an asset class, infrastructure, holds a great potential to actually deliver the 3 pillars of the Sustainable Development Goals, essentially the economy, environment, and social sustainability. When we look at this from a perspective of job creation and wealth creation and local economic growth, we can measure this project by project, especially when you bring in the right type of governance into the structures, right? So our experience has been that we have grown in terms of the ability to mobilize domestic credit over the past 3 years, from the initial project in 2017 to 4 projects so far that have achieved financial close and aggregate size of about 43.5 billion. The tenor has elongated to the maturity of up to 15 years, again, largely driven by local pension funds. So, you know, when I take some learning from the other speakers, I think Mr. Doherty talked about, this panel, they talked about governance and best practice being one of the, you know, the limelight of the pension industry. And I think this is something that is very much needed in terms of how, when we want to look at sustainable, you know, growth of our market. And whilst we may, you know, there may be criticisms about not having allocated as much as would have been expected, there are rational reasons for that, essentially because you're holding, you know, contributors' capital. There's a need to ensure that capital is preserved. And also, ultimately, I think the broader question now is around the impact of that capital. You know, is it creating jobs? Is it having, you know, is it providing impact beyond just merely making returns? And I think as we evolve, intermediation becomes a very critical, you know, pillar in all of this, because absolutely right that beyond just having, as a country, you know, it's estimated that we're between 25, about 30% of GDP in, you know, in infrastructure stock compared to 70% of other peer countries. And to grow from that, we have an estimate, I mean, broad estimate of how much, you know, some say that, you know, $3 trillion over the next 30 years. Some assume in terms of the amount that is required, incremental cost of 2 trillion naira per annum or annually is required. Now, we have these broad figures, but I think the focus is really around the governance and the type of assets that are being created, and the sustainability of those assets. And, you know, our experience has been that, you know, we have to take a holistic approach to solving this problem, beyond just, you know, purely from an investment side point of view, but also looking at it from the asset creation, you know, perspective as well. And the government has a role to play in terms of creating an enabling environment. The private sector has obviously a very important role to play as we envision a more private sector, truly private sector-led economy. But that would come from, you know, one, working with intermediaries. So, you know, InfraCredit is one of these intermediaries. There are other funds that are also playing similar roles in trying to allocate capital, long-term domestic credit to the private sector. Also building strategic approaches to where we want to be. So, you know, Mr. Falede has just really talked about the growth of the industry and sort of the successes to date. And we ask ourselves, what happens over the next decade, right? If you take a step back and look at over the past decade, I recall in 2016, when we were presenting at the setting up of InfraCredit, the pension funds were about 6 trillion. Today it's about 11 trillion. So literally between the establishment and 3 to 4 years of operations, the asset under management has literally doubled, but the allocation hasn't doubled because we need to create the assets. And when we look forward into the next decade, we're likely going to see a tripling of this portfolio, just merely by just the incremental growth in the market. And how do we strategically look at how to more efficiently allocate capital, you know, to assets? And that means it needs to be a roundtable conversation in terms of, you know, in terms of sectors, structures, products, and ultimately there is a win-win, I believe, and, you know, in being able to work out a strategic approach to asset allocation and create this economy, like the other panel talked about. You can actually create a private sector-led economy that is not necessarily dependent on certain other factors. Because the challenge in the market today is the lack of an alternative market. The lack of an alternative market means that the you know, institutional investors are heavily dependent on one source of, you know, asset provider. Now, the ability to create a private sector-led, you know, market essentially means that there's more allocation of domestic credit to the private sector that is creating jobs and supporting growth, but expanding the alternatives for that market. And I think that's really where the focus should be as we begin to look forward at strategically, where should we be in 2 years, 3 years, and ultimately 10 years time. Again, it's not for want of solutions or ideas, because I believe we do have very, very bright minds. I think it should be really around that honest conversation around collaboration. But I think I would say that there's been, on our part, we've seen success from literally nothing to something, and that really gives us more confidence that there's a significant opportunity for strengthening governance in terms of the type of projects that should come to market, leveraging what we see as long-term capital that can be allocated, and helping support more efficient intermediation, but obviously with stronger collaboration from the communities, the investment communities, and we can unlock that capital to be more productive, to the market.
Thank you very much for the perspective you actually showed. And like you mentioned rightly, it's good we have an issuer who has probably been able to unlock some of those assets that we're talking about today, and what needs to be done to probably ensure that similar competitors or similar firms in the space can also unlock such assets. So to Mr. Ibirunke, considering your recent participation in capital markets, being the pioneer client of InfraCredit, how were you able to more or less, how did you find the opportunity, and how was it able to maybe more or less drive the growth within?
All right, thank you, Babajide, and thank you, Business Day, for putting this together. And just to put a bit of context as well, thank you for helping me out, for that beautiful contest of Barton being the first or the pioneer issuer in that market. Just to also add to what Tina said, I'm sure most of us know Barton. We are a provider of energy solution in Nigeria. Our pride ourselves in the ability to produce and distribute 24/7 reliable power to underserved government, industrial, individual, commercial markets around the country. Our mission is to enable life through provision of energy solutions. We're mindful that this was a huge responsibility when we're starting at the outset, given that our funding requirement is long-term in nature. And at the time that we're setting out the business, certain restrictions that won't make a PFA touch our kind of investment was there. But thankfully, when InfraCredit came on board, we then became the toast of the market, and we're able to raise or start a program of 50 billion program, and we've raised 20% of that, 10 billion. And the journey has been very smooth. When we started the business, we started with bank borrowing because of the restrictions that were in place at that time. And the bank borrowing, as we all know, became very expensive at that time with shorter repayment terms and all of that. And given also that the business is capital intensive in nature, it then means that we have a mismatch in our horizon as well as the horizon of our capital mix. And so what we tried to do was to access this market, and we found the PFAs as a veritable partner because we both have mutually beneficial objective in as far as the horizon of our investment objective, tallies or as concerned. We then needed to refinance the very expensive short-term, bank borrowings that we were into, and so we had a more stable fund from PFAs, and I mean, I didn't say only PFA fund can provide such stabilities, that we needed. And what we have seen over the years is, a cash flow that is highly predictable, a cash flow where I have a fixed finance cost, and of course, other investors are very happy because it is not only that the fund is cheaper, it's more stable, it has a long-term horizon, and of course, the fact that InfraCredit is giving it a wrap around the solution, there's a leeway to what we can do, and I dare say there is a lot of headroom for growth out there if you want to access the capital again. It's been 16 years. For instance, the PFAs have been around for 16 years, and in those 16 years, there have been no incidents of any misappropriation anywhere. With total asset of 11 trillion, and when you look at 11 trillion naira in dollar terms, that's about just 29 billion dollars, and contribution base of 9 million. And if you compare that, a contribution base of 9 million as a percentage of the total workforce in Nigeria, which MBS has put at around 70 million people, it's just about 12.86% or 13% of that working population. We believe there is a room, a very huge headroom for growth. And of course, the other 40 billion that is still left for us to access, there's opportunity for us to do that with support of infra credit and some of the developmental activities that has happened in the industry.
Hello.
Hello.
Okay, sorry. Thank you very much for that. I was going to ask you, how soon are you coming to raise the balance in the market? Considering we've got information that the federal government is thinking of tapping the pension fund, and there are probably fears that might crowd out people like you.
Right. So as we all know that we can't just come to the market to raise the money for to put in a bank account. They are project driven. And we have also seen in our sector a lot of market friendly initiative from our regulators. Just to put in context again, we have moved Viatam from a business of 6 megawatts power to about 60. And that is multiplying it by 10 in the little time that we've been able to access capital. And we plan to grow that to about 200 megawatts in the next 5 years. And so we are likely going to come to market anytime soon. But of course, it's going to be project driven, and there are a lot of initiatives that are coming between our collaboration with some of the discos and how we're moving, the industry forward in terms of supplying accessible, reliable power to the underserved customers that I mentioned earlier. So, I mean, expect us very soon, and we're going to inform the market. Yeah.
I mean, we look forward to your coming, and well done for you utilizing the capital. I mean, in terms of multiplying the effect of capital raising. I mean, it becomes obvious to similar participants in the market that come to the market can be very beneficial to issuers. Maybe I would like to continue with Mr. Zubike now. In terms of the recent news that government is likely to come and take on more money, but the question people keep asking is that how do we ensure it is well utilized? So my next question to you is, what do you think needs to be done to ensure that incremental government borrowing from the pension industry can act as a catalyst to attract private capital for infrastructure development? You alluded to the fact that there's been mentioned about 2 trillion naira, $10 billion, all sorts of money, but the pension assets are only about 11 trillion today. And government is already about 7 trillion of that. So when you look at incremental borrowing, how can this be well utilized?
Thank you very much, Jide. So, what I find is when I look at examples of, projects that we have supported, and I try to, not even just Infra Credit, but other intermediaries, and we try to use illustratively these examples and try and either recompose it in a more scalable manner. I'll take a couple of projects. There was Viatam, there was North South Power, which is a hydropower project, and there was Gel Utility, which is an upgrade power solution provider. These companies all entered into public-private partnerships with government, whether at the subnational level or with a public government arm. And they invested private equity, right, or private capital into these projects, and then leveraged that with debt, public debt from the local pension funds. So essentially what we're seeing is how government is able to, one, create that economic opportunity by providing, bankable projects for the private sector to participate in, right? And creating, the right enabling environment in terms of legal certainty of these contracts. And by doing this, you're able to use your nominal contribution as government to crowd in capital from private sector, investment, operating and maintenance, but also from institutional investors, you're able to also attract local currency financing to match, obviously the revenue of these projects on a more sustainable basis. So, ideally, when we look at borrowing for growth or borrowing for, in order to attract, domestic credit to the private sector, I think the government can doesn't necessarily need to go directly to borrow these assets, because they're already examples, they're financing for other purposes, but if we're strategically saying that, the financing is for the purpose of, private sector, then, just there are already existing organs that play and have played and can play those roles in the BPE, for example, in enabling more PPPs to effectively be implemented. That brings in the private sector, and these companies can now go and raise debt to finance either the construction, rehabilitation, and then they can operate and maintain these assets. So we are very keen on engaging through institutions like the Bureau of Public Enterprise. We actually have a memorandum of understanding with the BPE to collaborate in that regard. We're also working at the subnational level, to encourage the subnationals who also have a very primary role to play in unlocking long-term infrastructure assets, to adopt similar models as well that we have already seen in the past. Bartan is an example of a PPP between Lagos State, where they basically sold off assets under a privatization process. The same with North South Power, we took a concession from the Shiroro, from the federal government. And the gel utility is also an NNPC and private sector-led initiative in terms of power solution for the refinery. So we've seen these examples. It's not as if it's not happening. It's really more or less how do you institutionalize this process and make it more efficient to crowd in capital off balance sheet, right? To private sector-led initiatives that can clearly create jobs, because we know that out of all the projects we supported, at least 100 plus new jobs have been created. And we see the impact in the local economy where these institutions all operate. So there are mechanisms that already exist. I think the refinement is really around the strategic approach to mobilizing capital. And I believe that from the conversations we're also having, at the government, at the BPE level, there are discussions around privatization that initiatives that will be implemented for roads and for other assets. And at a subnational level, there are also interesting discussions that are being had. But where the pension funds play a very key role is being able to allocate domestic credit to the private sector. Long-term in local currency is being done, and it can be done again or strengthened or leveraged further. It's really that strategic approach. So, my simple answer to this will be that it's really just being able to implement more efficiently existing measures in place that have already been able to incrementally leverage private sector investments in infrastructure.
Thank you very much for that. I mean, that probably was around my thought also. Considering based on the example you cited, you've largely done transactions in the power sector. And that will take me to my next question from Mr. Falade. Now, government is trying to borrow. They're already about 66% of the pension assets. So the question now is this, that for the incremental borrowing, how can we ensure that if they go to alternative assets, they can more or less achieve the required goal? We have this example. Recently, over the last 3-4 years, government have come to the market to borrow using the Sukuk structure, which has more or less sequestered or more or less ring-fenced a few roads and more or less invested in those roads. They are more or less, that structure is largely something that you can say finance kind of structure, and it seems to be working because the roads are being delivered. So what do you think will be the approach for this next borrowing drive by government?
Thank you very much. And I think that's a very, very useful question. I agree with you. Sukuk has been quite a transparent way of getting government to borrow, especially to invest in infrastructure. It's laudable, it's very transparent. However, from pension fund perspective, when it comes to infrastructure financing, The financing can come via bonds. It can also come via funds, or structural funds, via the specialist investment funds vehicle. And it could also be via PPP. Obviously, to protect the pension fund, there are limits around how much these vehicles use. For government in particular, just like somebody mentioned earlier, the allocation to government is on the average largely about 70% to all type of government borrowing. And so the thing is that even Sukuk comes under that bond limit. So all I'm trying to say is there's a limit to how much government can even utilize Sukuk now for borrowing, because the borrowing level currently is at about 66%, as earlier mentioned by somebody. And so the actual exposure now is about 66%, and the limit is about 70%, which shows there's just a little headroom left to borrow via Sukuk or via bonds. So that then speaks to some of the conversations that have happened today around the use of other alternative type of vehicles for government to try and use when it comes to financing infrastructure. Infrastructure, just like as mentioned, it's very, very key to development of any nation, especially Nigeria, where we all know that our value of our infrastructure assets is just about 30% of GDP, compared to 70% in developed countries. And we also know that even the finance minister told us recently, we need an annual 36 trillion investment several years in order to bridge our infrastructure gap. So the way for government to go is very similar to what has been said earlier on, which is to find and leverage on partners to collaborate with, especially to utilize the infrastructure fund allocation. The allocation to infrastructure funds, I think, is about has a limit of about 10%, of which only about 1% has been utilized on one hand. On the other hand, there's also what we call exposure via variable income asset class, which bundles a number of asset classes together, which includes ordinary shares, open-ended funds, and specialist investment funds, meaning infrastructure funds and the private equity. All of these have about 55% maximum of the fund's headroom, of which only about 7% has been utilized. So where you have 55% headroom and only 7% has been utilized, it also shows that potentially there's headroom for government to also come in and play in that regard. But either way, the way forward is via collaboration with investment managers. In other words, government needs to identify very good investment managers that would be able to tick all the boxes required in investment guidelines, i.e. the promoters need to demonstrate track record of performance of at least 10 years, and so on and so forth. They also must be able to attract credible multilateral organizations, ADB and IFC and their type, to come and also play into the fund. And just like we've been told earlier on, infra credit also plays a major role in this regard. And one key example I always like to cite here is the Azura Power Project. I've also not been mentioned. I mean, it's just an example of how government can come in and collaborate effectively with private sector players and still be able to achieve goals of attracting pension fund investment and, in fact, other private capital investments into infrastructure.
Yeah, thank you very much. I think a point you raised is about the fact that the debt asset class is almost, the limit is almost maximized by PFAs. That brings my next question, which I will make it a twin question to both Mr. Ibironke and Mr. Doye. I think Mr. Ibironke can go first. Due to time, maybe we'll just take about a minute and a half each to respond. Yes, debt investment, like it has been alluded to, has largely driven the power sector. I mean, locally now, I mean, for private firms like Mr. Azubike mentioned earlier also. So what do you think needs to be done to attract equity to your space? And a follow-up question for Mr. Adoye would be, yes, PFAs are avoided variable instrument largely to a large extent. What do you think, what strategies do you recommend to mitigate the risks they are probably concerned about, which I think are very, very genuine? So maybe you can kindly go ahead.
All right, thank you, Babajide. And so for me, both debt capital and equity capital are both capital that I need in my industry, if you ask me. They all have their advantages and disadvantages to my POL and of course on my balance sheet as to what I'm trying to achieve. In terms of my debt capital, which I currently have, what I would say is the major setback would be the fact that the finance cost will be huge and I'm not able to come back to the investors after I've issued at say 16% at 7.5, 7 to 9%. I can't come back to them immediately to say I want to quickly change from 16% to my 7% because it's a fixed medium term, fixed interest capital. Then becomes another variant you might also consider in our space. I'm an advocate for regulator to permit, if possible, that PFA should have a direct equity investment in infrastructural building, a space in Nigeria, because we have a huge infrastructural, deficit, as we all know. This way, both parties can plan and structure their cash flow in a way that had long-term sustainable value. And of course, I believe Nigerian economy will be the direct beneficiary for this. So regardless of what the current guidelines on terms of investment options that are available to PFA is, if they are allowed to bring direct equity investment to the infrastructure space, apart from investing through private equity, but for them to have a direct investment will go a long way in also deleveraging the already highly geared, infrastructure sector that we are in, because power, we all know, is capital intensive. And of course, most of those are coming from which will also make the community to be highly. So to give us a little bit of breath, and I think equity investment should be encouraged by PFAs into the sector. Thank you very much.
Okay, thank you. Over to Mr. Day.
Yeah, thank you again. I think, just to step back a bit, I do think there's a lot of discussion generally around financing of infrastructure, which I assume for the most part are real assets. Internally, one of the framework that we have developed, because, we just believe that is, the most logical way to deploy money is towards, broad-based, wealth creation, is that we developed a framework, we adopted a framework called the National Prosperity Framework, which says that, for any country, for any investment manager or even country, there are four key factors that drives wealth creation from a capital allocation perspective. One is human capital. So your skills, your productivity, who is funding that? The second is social capital, healthcare, education, property rights, and even legal, the legal environment, who is funding some of the infrastructure that ensures that all those things work properly. The third is real assets. We've had a lot of discussion around real assets, and I believe that there's a lot of activities in that space, but real assets is not the only key driver for national prosperity. The fourth, which is an enabler of all three, is financial innovation, which is where, PFAs fit, so we have to do work across all four levels, and this is the reason why alternative investment is very important, particularly venture capital and private equity. to answer your question specifically, how do we mitigate risk? I think, we define risk specifically as the probability of permanent loss to capital. And I think that, it's, it's the same sort of, widely known, mitigants, right? The key one is familiarity with, the investment product. I think that, a lot of work has to be done in terms of creating a framework to allow capital allocation, purposeful capital allocation into the alternative investment. Because the reality of the matter is that if you back private equity investors that are only investing in mature markets, what amounts of wealth creation are you really, are you really sort of, enabling, given your allocation in quoted securities. So we think that the first thing is familiarity. The second, we believe are, just sort of having a dedicated resource to creating an alternative, to building an alternative portfolio, an alternative strategy portfolio, which means that, if you have to use the fund of funds, or even if you have to sort of act as, the enabler for foreign capital. But one of the things that we do know, though, is that, one of the key roles that the pension funds, I believe, have to play is that they have to be the local intelligence. For example, we've had a lot of DFIs play significant roles, but the DFIs represent their own governments. Their objective oftentimes, is very broad, right? I mean, I don't think they have specific, specific strategy, for sometimes the nuances, of each locality. This is where the pension funds have to sort of play a very active role in providing that local intelligence. For example, creating the framework. What is the output of the framework? What are the key measurements? Is it jobs that we are creating? Are those jobs meaningful jobs? What is the output? What is our own output in Nigeria? The poverty rate is very high. Is it GDP per capita? So those are some of the areas where I believe, pension funds have to work in terms of just mitigating some of that risk. Creating a framework that matches our reality. And the most important, obviously, from a portfolio perspective, is that you want to avoid disasters. Because ultimately that's what kills portfolio. So you have to look at managers, as Mr. Faladay mentioned, with a track record, managers that have, experience, managers that that they know what they're doing, and managers that are quite practical in the way they sort of apply their strategy in the market.
Okay, thank you very much, and thank you for bringing the perspective about inclusive growth and economic development. That takes me to my next question for Mr. Amisu, which is, I mean, there have been thoughts about should PFA should PENCO more or less allow PFAs invest in foreign assets? I mean, there are various school of thoughts around that, and a key school of thought is the fact that we need social domestic capital. We're working so hard to attract foreign capital. Why on earth would we want to export that same capital? So my question to Mr. Amisu is, considering PFAs have the capacity to play a developmental role in Nigeria, what would be the justification for the regulation to allow investment in foreign assets?
Thank you very much, Babajide, for that question. I will start with that parable of if the home has not fed well, why would you take the food outside? That is the first thing that will come to play in the minds of our regulators to allow us to invest in foreign capital markets. Now, yes, because of certain pressures that have been coming from different angles onto the National Pension Commission to allow us to invest in some certain asset classes outside the country. Yes, there has been some movement. But looking at the current regulatory framework, and besides, if you look at the instruments currently available, many of these instruments will not be, the effective hedging of currency risk in our market currently is very, very low. That is why, for now, it's not going to be very, very attractive for PFAs to invest outside the country. But be that as it may, as we said, looking at the track record of the pension fund administration in Nigeria, the savings, the capital, the development of capitals that have been made in the last 16 years to about 11 trillion currently. Now, I think there is a huge possibility for us to have this happening in the next few years. But for now, the condition and the environment is not suitable for that. And I don't think the National Pension Commission would because of the volatility in the market worldwide currently, the reality of the current situation will be allowed to invest outside the country. But there is a huge possibility of that happening very, very soon.
Okay, thank you very, very much. And I think it's been a very engaging one. I will just wrap up now and allow each of the panelists to probably give a closing remark in a minute each. So, I mean, considering we've discussed various things around the traditional asset classes, alternative assets, asset allocation to infrastructure, still about 0.5%. Our total AUM is still about 11 trillion. It looks exciting in Naira, but in USD terms and in terms of what we need for our development is still quite, we have a long way to go. We've done really well, but it's the reward for hard work is more work, and we need to really grow the assets. Things around, but aside the fact that we need to also more or less improve yields in Naira and the absolute as maybe US dollar, considering that someone mentioned that over the years, the pension asset have probably returned a flat return in USD, though in Naira, it will be doing well. And a lot of people argue that alternative assets has a significant diversification effect on portfolios, and which will eventually also help mitigate portfolio risks. So, these are kind of thoughts we probably need to keep engaging to see what needs to be done to ensure that we are able to more or less diversify pension assets further and also reduce total portfolio risks. So I'll allow each panelist to go ahead and just starting from Mr. Zubike.
Thank you. So history has shown us that the pension funds can achieve some level of impact, right? And we've seen that to some extent. We've also, over the past 60 years, it's clear that there's a significant amount of mobilization of capital that has happened and can happen in terms of incremental growth. I think going forward, the real question is, what will drive impact would really be innovation. And innovation will come with, collaboration and more strategic approach within, the industry. I think these things would be transformational, in really achieving that collective, to collaborate, to innovate, and to achieve impact and scale. So I think that's what I would say here.
Thank you very much for that. Mr. Falade?
Yeah, thank you very much. What I would just like to add is that Nigeria is currently running the Chilean type of Chilean model type of pension. In other words, the model was borrowed from Chile. What had happened in Chile was that ahead of the pension reforms, there was financial reforms. Because of that, there were a number of asset classes that were already in existence before the pension fund was introduced. So as the capital grew, obviously there were asset classes matched with the fund. Nigeria, on the other hand, seems to have done it the reverse. We form the pension space, but the asset classes are not there. Why, if you look in the investment guidelines, you see all sort of asset classes like mortgage-backed securities, asset-backed securities, specialist investment funds, infrastructure funds. They are nowhere to be found. So I think this speaks largely to what a number of contributors have said today. The need for the wider financial industry to engage and collaborate to ensure that all these asset classes are now created in order to be able to match the funds that will come on, especially as we approach the next decade. The contribution of Nigeria pension industry to GDP is just about 7%. If you check the history of other countries that have also done pension reforms, Chile and their likes, the sort of contribution of their pension industry to GDP is nothing less than 50, 70. Even South Africa is doing over 50%. So that speaks to the huge potentials that the pension industry in Nigeria has going forward. So I think a lot has to be done. I think what a number of contributors there today have said. It's down to all of us to ensure that we collaborate and we cooperate, even with government. I think a lot has to be done with government in terms of engagement, in terms of getting government to understand the risks around investments, so that potentially we can all come together and come up with mitigants that can be deployed, and the necessary credit enhancements that can also be deployed to the product that will be brought into the market to enable the nation move forward in terms of GDP, in terms of employment, in terms of also ensuring that even the contributors to the pension funds earn risk-adjusted returns and real returns on their funds.
Okay, thank you, sir. Mr. Ibrahim, kindly go ahead, summarize very quickly.
Thank you very much, Babajide. So, as I said earlier on, Leviathan been able to raise 10 billion, about 20% of our 50 billion bond program, and about 18 PFAs participated in that deal. And I can tell you here today that the impact of that has been very huge. So the impact of PFA money, whether as debt or equity in infrastructure space, is very, very huge. And I would like to break it down using Leviathan example into three perspectives. And I'll call it the 3 P's impact. The profit impact, it's monumental because we've been able to significantly reduce what was a very high finance cost to a more stable fixed interest that I pay annually on those money. From people part of things, we've been able to increase our workforce from just about 50 when we started to about over 350 as we speak today. And that big impact for me is huge. More important impact, which is the last but not the least, is also on the planet. So from ESG's perspective, part of the bond proceeds that we raised in 2017 was used to build a CNG plant somewhere in Abeokuta that has a 144,000 scum capacity per day. And when you quantify that in terms of the carbon emission or reduction that has brought into the system, the impact is also huge. And so for me, there is a lot more to be done because there is, like I said earlier on, we only have just 9 million contributors, out of about 70 million, working class in Nigeria, according to NBS studies or statistics. We have a lot more to do. There's a lot more to do from a infrastructural perspective. It can help us to improve more in ESG. It can help us to improve more in people. It can help us to improve more as we grow the economy generally. So the impact is huge, and PFA should be encouraged, and the industry should be encouraged more. And as I said earlier on, I've only got 20% of my issuance. There's an 80% more, 40 billion that I'm still coming to raise from the market as a regulator begin to give up small power sector regulation that is a bit more market friendly. We're going to come back to you, and please watch this space. Thank you.
Thank you very much. Mr. Adoye.
Yeah, thank you. I think I'll go with 3 key areas. One is that one is what I refer to as systems thinking. Everything is interconnected. No asset manager operates in a silo. So it's very important that the private sector, exerts some influence to ensure that, our economy, is consistently well managed. And the second one, I think, many of my esteemed panelists have mentioned it, is around trust and collaboration, which is very, very important, in the success of any economy, of any market. Trust is around governance, is around sanctity of contract. And collaboration definitely is an offshoot of that, and without both, it's very difficult to have innovation. And we know for a fact that with where our economy is, formal, informal, innovation is extremely important, to even be able to sort of formalize, the informal market. The third is wealth creation. Because of the high poverty level, every naira spent is extremely important and has to be deployed efficiently. So we think that every naira spent that is not deployed to help drive broad-based wealth creation is probably a naira not well spent. And I think that's a responsibility that all asset managers and deployers of capital, has to take to heart.
Thank you very much, Mr. Adeoye. Mr. Amisu.
Thank you very much, Babajide. I think for the pension industry, the pension space, the most important thing is the asset retention. First and foremost, has been demonstrated and illustrated by our regulator every time. I think, beside the fact that it's a seemingly difficult situation, we find ourselves in a situation whereby our stakeholders, that is our clients and the business owners, are still looking for ways by which we can still squeeze out enough returns for an investment on most of the asset classes. So the infrastructure finance that we're talking about and how we can use the pension funds to see how we can drive this is very, very important. Going forward is going to be a collaborative and a partnership with the private sector. So we'll just be on the lookout and looking for opportunities that we can use to make sure that we generate enough returns for our clients and our other stakeholders as well. Despite the seemingly difficult business environment, we believe there are still some certain opportunities that we can use to grow our assets in a manner by which our stakeholders will be happy with our performance. We will be looking out the infra credit that we have just heard about with the things that we can do as well. So I think there is much in the future for us in the infrastructure space. Thank you.
Thank you very much. Just to summarize the thoughts of the panelists, I mean, it's been about, Mr. Falade mentioned the pension asset being at 7% of GDP and expected to get to where the peers are. And that might see us grow about 6-7 fold. And it was also mentioned by Mr. Amisu, things around what needs to be done to drive that growth with the informal sector. And the previous panel also mentioned how technology can be used to drive this growth. Also mentioned were issues around how do you deploy the assets that you aggregate after raising the AUM. Very key were issues around governance and ensuring that the right structures are put in place to ensure that wealth is preserved. And also, I mean, that was mentioned by Mr. Adeoye, and Mr. Azubike also mentioned how this can become a catalyst for the required growth opportunities that we're trying to achieve. And also important is the fact that asset managers also need to wear their caps now and create products in the alternative space that ticks the various boxes that is required. Once again, I would like to thank all the panelists and also appreciate Business Day for this opportunity at this time. It's been a very engaging conversation. Thank you, everyone. And Business Day, thank you for this opportunity. I would like to call on the MD of Business Day, Dr. Ogo Okiti, to take over from here. Thank you, everyone, once again.
Thank you. Thank you, Business Day.
Yeah, thank you so very much, Babajide Fadamsi, for that, coordinating that group of eminent speakers. It was a very fantastic panel session, and I thoroughly enjoyed it. And so let me now use this opportunity to close and to close this conference and also thank everyone. But before I do that, I want us to reflect. I want to reflect on 2 points that kept coming up, right from the start of this conference. And the first one is the enormous opportunities that that exist for growth of the pension assets in Nigeria. Everyone just kept talking about those enormous opportunities, and I really hope that there's a way in which we can galvanize all the stakeholders to improve the opportunities in growing these assets. And of course, another point also related to that is also growing not only the assets, but the value that the assets give to those that require their pensions. Through a mix of assets that are available, whether on government or the private sector, equity, and every other thing. I really hope that, and I hope we have arrived at the point that we can begin to really look at how we grow value of our pension assets. So that's the first one. The second point, obviously, is the continuous critical role of the government, which everyone kept talking about, the role of governance in the pension industry. So I really hope these 2 points is something that we take away from here, and hope we can build on even outside of this conference. Let me now conclude by thanking all our speakers. It's been very, very insightful. They have given us their knowledge, their time, and of course, their wisdom this morning and this afternoon. So I really, really want to thank them, starting with Dr. Andrew Levin of PwC, and of course, the perspective provided by Wale Hodutola that's the managing director of ARM Pensions, and Abiodun Hoyelodun of DT Commercial Solicitors, and of course, the first panel moderated by Tunji Andrews, and of course, the last panel that just spoke. So we thank you all for spending your time with us here today, and we really, really thank you for the insights and the ideas and the knowledge that you have shared. I believe that our audience have benefited immensely from this contribution. So we thank you so very much. Finally, let me thank our 2 sponsors. We are very, very grateful to them. That's Infra Credit and Crusader Sterling Pension Managers. I want to thank you all for partnership with this, partnering with Business Day on this conference. And finally, to our audience, thank you so very much for staying with us up to this time. And we appreciate your time. And we do hope that this has been immensely beneficial to you and the work that you do. So thank you very much. And I really hope that you have a great Business Day afternoon. Thank you and God bless you. Bye-bye.
Thank you. Thank you, everyone.
Thank you very much, Chair.